Please like, share, and subscribe. Wishing you happiness and good luck every day.
For most of us, the single biggest obstacle to successful investing isn't picking the right stocks. It's not about finding the next big thing. The real battle, well, it's the one we fight against ourselves, against our own emotional instincts every single day. Today, we're going to dive deep into this problem, and more importantly, explore a solution, all based on the fantastic insights from the book Buy and Hedge.
All right, so here's our roadmap. First, we're going to take a hard look in the mirror and identify the real enemy in our investing lives. Then, we'll see how the market's crazy swings just pour gasoline on that fire. From there, we're going to completely flip the script and talk about a new mindset that puts risk first. And that'll lead us right into an introduction to hedging and, finally, the whole buy and hedge system itself.
Okay, let's get right to the heart of it. The biggest problem we face isn't on a stock chart or a financial spreadsheet. Nope, it's in the wiring of our own brains. This is a psychological fight long before it's a financial one.
Now this right here, this is one of the most important things you'll ever learn about investing. Just let that sink in for a second. The pain you feel from losing $1,000 is literally twice as intense as the joy you get from gaining $1,000. This isn't just some fun fact. It's the psychological tripwire that causes so many investors to fail.
I know what you're thinking. Golf? What in the world does professional golf have to do with my portfolio? But stick with me here, because to really get how deep this bias runs, we have to look at a place where performance is measured with absolute precision.
There's a name for this phenomenon. It's called loss aversion. It's that gut-level, hardwired instinct to protect what we already have, way more than our desire to go out and get something new. And what's wild is that it affects everyone, even the absolute best in the world at what they do. Okay, this is just fascinating. The book talks about a huge study of over 2.5 million putts on the PGA Tour, and the results were stunningly clear. You can see it right here in the table. When a pro is putting for par, their goal is to avoid a loss. That is, avoid getting a bogey. But when they're putting for a birdie, the goal is to acquire a gain. And even for putts of the exact same distance and difficulty, they were consistently more successful when they were trying not to lose.
And that's the whole point, right? If these elite, mentally tough athletes are subconsciously driven to play defense just to avoid a one-stroke blemish on a scorecard, what do you think happens to the average person when their entire life savings are tanking in a market crash? That exact same instinct kicks in, and it causes us to do the absolute worst thing possible: panic and sell at the very bottom.
So, we've established we have this faulty wiring in our heads. Now let's add the second ingredient to this. Let's call it a disaster cocktail. Market volatility. When you mix our emotional flaws with the market's wild ups and downs, you get a recipe for terrible decisions.
The book uses this analogy, and it is just perfect. We all know that compounding is this amazing, almost magical force that builds wealth over time. It's the Superman of investing. But those big, gut-wrenching market swings, that's its kryptonite. It totally neutralizes Superman's power.
Let's make this real. Imagine your portfolio goes through a major crash, kind of like 2008. Your account is down 50%. It's cut in half. The emotional pain is one thing, but trust me, the financial math is about to get a whole lot uglier.
And here it is. This is that brutal math of volatility I was talking about. To get back to even from that 50% loss, a 50% gain isn't going to do it. Not even close. You have to double your money. You need a 100% return just to get back to where you started.
This slide just lays out the cold, hard facts. It's what we call the asymmetry of loss. Look at how the required gain just explodes. A 10% loss? You need an 11% gain. Manageable. But a 50% loss puts you in a hole so deep, it requires a heroic effort to climb out. This is the mathematical trap that absolutely wrecks long-term portfolios.
Okay, so we know our emotions can betray us, and that volatility is a killer. How in the world do we fight back? Well, the book argues that it all starts with a complete, fundamental shift in how we think about investing. It's a totally new mindset.
This slide really gets to the core of it. Almost every investor, probably 99% of them, is obsessed with the output, the returns. But here's the secret. You can't actually control returns. The buy and hedge philosophy says to stop looking at the output and focus entirely on the input, the amount of risk you take. That is the one thing, the only thing you have 100% control over.
This quote here is basically an unbreakable law of investing. Everybody gets the first part. You got to take risks to get returns. But the second part is actually way more important. The only way you can suffer a catastrophic loss is if you first take on catastrophic risk. So if you can control that risk, you essentially prevent the disaster before it can ever happen.
So how do we do that? How do we practically control risk? Well, that brings us to the main tool in the toolbox, the central idea of this whole strategy: hedging.
Now, the word hedging can sound really complex and intimidating, but the idea is incredibly simple. It's just insurance for your portfolio. That's it. It means you decide up front, before you even buy the stock, what the absolute maximum amount you are willing to lose is, and then you put a mechanism in place to make sure you never lose more than that. Period.
I absolutely love this analogy from the book. Imagine you're offered a new job, but in the contract, there's a clause that says, hey, if this doesn't work out in the first 6 months, you can have your old job back. No hard feelings. Think about that. Wouldn't that take away almost all of the stress and fear from making that big decision? Well, that's exactly what a hedge does for an investment. It defines and contains the risk of being wrong.
And this is how you finally win the battle against your own brain. When you predefine your maximum loss, the hedge acts like a circuit breaker for your fear. That feeling of panic from loss aversion, it's gone, because you've already made peace with the worst-case scenario. This is what allows you to survive those crazy market events and, maybe most importantly, to actually sleep at night.
Okay, so let's pull all these pieces together now. Hedging isn't just a clever trick you use once in a while. It's actually the bedrock of a complete, disciplined system for managing your money for the long haul. This is a great concept from the book, Finding Your Investor Tempo. Think about it like a musician who has to keep a steady beat. It's about creating a calm, repeatable routine. You're not checking your stocks every hour, getting whipped around by the headlines. Maybe you review things once a quarter. This tempo is what keeps you from making those emotional, knee-jerk decisions. And that tempo is guided by these 5 iron rules. This is the real, practical core of the strategy. Number 1, hedge every single investment. This is not optional. Every position you own has downside protection built in from day 1. 2, know your risk metrics. You have to be able to say in cold, hard dollars, if I'm wrong on this, I will lose X amount. No ambiguity. 3, diversify for the long term. You know this one, but it's critical. Don't bet the house on a single idea. 4, and this might surprise you, unleash your inner guru. The system actually encourages you to take a small part of your portfolio, say 5 or 10%, and speculate with it. This gives that gambling itch an outlet so it doesn't contaminate your core holdings. And finally, number 5, harvest gains and losses. This means having a system to take some profits when things go well, and just as important, to automatically cut your losers when a hedge gets triggered.
And that really brings us to the most important question of all: your goals. Things like retirement, paying for college, financial freedom. Those are all long-term goals. And the road to get there is guaranteed to be bumpy. There will be market crashes, there will be recessions. A strategy that's just based on hope is not a strategy, it's a wish. The real question you have to ask yourself is this: is my investment plan actually built to survive the journey?
All right, welcome. What if I told you that the single biggest mistake that most investors make has absolutely nothing to do with picking the wrong stock? Nope, it's all about focusing on the wrong thing entirely. Today, we're going to dig into a fundamental truth about how we make decisions, something you do every single day without even thinking about it. And then we're going to apply it to your portfolio in a way that I promise will change your whole perspective. So here's our game plan. First, we'll look at life's hidden risk equation. Then, we'll talk about why we are so obsessed with returns. We're going to make it real with a big decision, like changing jobs. From there, we'll see how one simple twist can change everything, which leads us to the most important part: how you can finally take control of your inputs. Okay, let's kick things off with a foundational idea. You are a risk manager. We all are. It's just baked into our DNA. And to prove it, I want to tell you about a scene from a classic movie that has one of the strangest, but also one of the most brilliant risk calculations I've ever come across. So this line is from The World According to Garp. The main character, Garp, is looking at a house to buy when a small plane literally crashes into it. And his reaction isn't fear or panic, it's a business decision. He sees it as a deal. In his mind, the worst possible thing has already happened, so the risk is gone. It's pre-disastered. Now, obviously that's an extreme example, but it perfectly shows how our brains are always, constantly, weighing what could go wrong against what could go right. And that brings us to the most important insight of this whole discussion. Look, everything boils down to a super simple, powerful equation that the financial world loves to make complicated. Here it is. Risk is your input. It's what you put into the machine, the decision you make. The return, well, that's the output. It's the result. It's what comes out of the machine. Just getting this one distinction right is the very first step to taking back control of your financial life. Okay, so if it's that simple, input and output, how do we get it so wrong? Let's dig into how this basic misunderstanding leads pretty much every investor down the exact wrong path. We have become a culture that is obsessed with the result while totally ignoring the thing that causes it. You know, this slide really lays out our bias perfectly. Why do we focus on return? Because it's the prettier sister. It's simple. Did my account go up or down? That's, what, 5th grade math? Risk, on the other hand, that's the input. That's the hard stuff. It involves concepts like standard deviation, 10th grade math. It's a little more intimidating. But here's the crazy part. We pour all our energy into the output, the return, which we can't directly control, and we totally ignore the one thing we can control, the risk we choose to take on. To really make this hit home, let's step away from the stock market for a minute and look at a universal decision that forces every single one of us to think deeply about risk versus reward, deciding whether or not you should take a new job. Come on, we've all made this list, right? You're sitting there with a piece of paper or a spreadsheet, weighing the concrete stuff, like salary and the commute, against all the fuzzy stuff, like, will I like my new boss? Or is this industry even going to exist in 10 years? It's this super stressful, complex process, and it's stressful for one reason, because the stakes are high and the future is a complete unknown. You're performing an incredibly sophisticated risk analysis without even calling it that. And that right there, that deep, thoughtful, agonizing process, that is exactly the kind of elevated thinking you need to be a great investor. But let's be realistic. Can you imagine making a detailed pro-con list like that for every single stock you're thinking about buying? Of course not. You'd be totally paralyzed. It's an impossible task to do over and over again. But what if you didn't have to? What if, instead of trying to get better at predicting an unpredictable future, we just change the rules of the game itself? Let's go back to that job offer. But this time, let's add one simple imaginary twist. Just imagine this for a second. Your potential new boss and your current boss get together, and they come to you with this amazing deal. They say, look, take the new job, give it a shot, and if you don't like it, if it's not what you hoped for, you can just undo it. How would that change your decision? How would that change the entire feeling in the pit of your stomach? Let's give this a name. Let's call it optionality. You've basically got a 90-day contract that says you can go back to your old job, same pay, same desk, no questions asked, as if you never even left. All of a sudden, the catastrophic risk of making the wrong choice, it's gone. The worst-case scenario is no longer, I'm unemployed and ruin my career. The worst-case scenario is now, well, I'm right back where I started. And this just brilliantly shows the mental shift. That whole agonizing, endless pro-con list, you can just throw it in the trash. Your whole decision-making process becomes incredibly simple. You're not trying to guess the future anymore. Instead, you're analyzing just one thing. Is the potential upside of this new job worth the known fixed cost of having this safety net? You haven't predicted the future better, you've just changed the entire game. Now here's where we bring it all home. This whole idea of an option, this safety net that protects you from the absolute worst outcome, it isn't some fantasy scenario. In the world of investing, it is a very real, very powerful tool that's available to you right now.
It's called hedging. Honestly, just think of it like buying insurance for your investments. You use a specific financial tool, it's often a type of contract called a derivative, to create that exact same get-out-of-jail-free card we just talked about. For a known cost, like an insurance premium, you can build a floor under your investment that basically says, no matter what happens, no matter how crazy the market gets, my loss on this investment will never be more than this specific, measurable dollar amount. You get to predefine your worst-case scenario.
So what does this all mean for you, the investor? It means you can finally stop obsessing over the output, the return, that thing you can't control, and you can start focusing all of your energy on the only part of the equation you can actually control, your input, the risk. When you hedge, the vague, emotional, frankly terrifying concept of risk suddenly transforms into something beautifully simple and concrete, a number.
It's the maximum amount of cash you can possibly lose if everything goes wrong. Risk stops being this monster under the bed, and it becomes a known variable, a line item on a spreadsheet that you can plan around.
So let's just lock in the 4 big takeaways here. Number 1, risk is your input. It is the one and only thing you truly control. Number 2, return is the output. It's the result, and you can't directly control it. Number 3, to be a truly effective investor, you have to learn how to measure both. And finally, number 4, hedging is the practical tool that lets you actually control your input because it simplifies the whole messy idea of risk down to a single manageable number. So I'll leave you with this one question to think about. Take a really honest look at how you make your investment decisions. Are you actually analyzing and managing your inputs, focusing on the one thing you can control? Or have you just been distracted, like so many others, staring at that unpredictable, uncontrollable, prettier sister? The choice and the control is all yours. You know, when we think about financial risk, we tend to look outward, don't we? We worry about market crashes, recessions, things like that. But what if I told you that the biggest opponent you will ever face in your financial life isn't out there at all? It's much closer to home. In fact, it's right between your ears. It's your own emotion. I love this line. It's hilarious, right? Tom Hanks is trying to manage his all-star team, but really, it's the perfect way to think about the battle we all face, trying to keep our own feelings out of our most critical, rational decisions. And the tricky part is, it's a battle most of us don't even know we're fighting. Okay, so here's our game plan for today. We're going to start by digging into this unseen force of emotion. Then we'll zero in on the biggest, most powerful bias of them all, something called loss aversion. We'll even see how it trips up professional athletes, how it leads to the single most common mistake investors make, and finally, we'll talk about a real practical strategy to fight back. So let's talk about this unseen force. I mean, we all like to think we're being logical, right? You've got your spreadsheets, you've read the reports, you've weighed the pros and cons, but the whole time underneath the surface, your emotions are there, kind of pulling the strings, especially when the stakes are high. So why are our emotions so deeply involved? Well, it's not a flaw, it's a feature. It goes way back. For our ancestors, survival meant reacting instantly to threats, right? Avoiding that saber-toothed tiger was a lot more important than finding a few extra berries. And that ancient wiring is still there. So when it comes to money, our brain doesn't just see numbers. It sees survival. It sees food, shelter, security. We're not just making a choice about a stock, we're making a choice about our well-being. And that primal link makes every financial decision an emotional one. Now, out of all the emotions tangled up with money, there is one that stands head and shoulders above the rest as the most powerful and the most destructive. It's a psychological quirk that is responsible for so many of our worst decisions, and it comes directly from that survival instinct we just talked about. Let's meet the main villain of our story. It's called loss aversion. The idea is actually pretty simple, but its effect on us is huge. Countless studies have shown that the psychological pain of losing $100 is roughly twice as powerful as the joy of gaining $100. I want you to really let that sink in. Our brains are hardwired to play defense. We are far more motivated to avoid a loss than we are to achieve an equal gain. And this imbalance you see here, this is everything. That little jolt of happiness from a $1,000 win is just completely overwhelmed by that sick, gut-wrenching feeling of a $1,000 loss. And this isn't just you being in a bad mood. It's a cognitive force that literally warps your judgment and pushes you, me, all of us, toward bad decisions. Now, if you're thinking this is all just some abstract psych theory, I've got an incredible real-world study for you. And we're going to a place where you'd expect logic and precision to rule the day, the world of professional golf. So let me ask you, professional athletes, right? People at the absolute pinnacle of their sport, with millions of dollars on the line with every move. Surely they have to be cold, calculating machines, don't they? Well, the data tells a very, very different story. A couple of professors from Wharton dug into an unbelievable amount of data. We're talking about more than 2.5 million putts. Every single one of them measured with lasers for pinpoint accuracy. This wasn't some small experiment. This was a massive deep dive into the minds of the world's best golfers under intense pressure. And here's the brilliant part of the study. They compared 2 situations that were physically the exact same. So imagine a 10-foot putt. In one scenario, the golfer is putting for a birdie. That's framed as a gain. In the other, he's putting for par, which is all about avoiding a loss, avoiding a bogey. Same putt, same distance, totally different mental frame.
And the results? It's a perfect picture of loss aversion in the wild. The data was crystal clear. Pro golfers are way more successful when they're putting for par. Why? Because when they're trying to avoid the loss of that bogey, they're more focused, they take more care, they just make the putt more often. But when they're putting for the gain of a birdie, they actually get timid, tentative, and they often leave the ball short of the hole. And get this isn't just a fun little stat. This one mental glitch costs the average pro golfer over $10,000 per tournament. $10,000! Just think about that for a second. Every stroke counts the same on the scorecard, but their brains don't see it that way. Now, if loss aversion is strong enough to cost elite athletes that kind of money, what do you think it's doing to the rest of us when we look at our investment portfolios?
So let's take that lesson right from the golf course and bring it back to our own money, because this very same bias is the direct cause of what is, without a doubt, the single most destructive mistake an individual investor can possibly make.
This right here is the dangerous little mental game that loss aversion makes us play. The pain of actually admitting you made a mistake and lost money is so intense that we create a loophole. We tell ourselves, hey, it's not a real loss, it's just a paper loss, as long as I don't sell. This is the classic trap. You buy something for 50 grand and it drops to 25. The rational move might be to cut your losses and move on. But that feeling of making it real by hitting the sell button is just too painful. So what do? We hold on, we hope for a miracle, and all too often, that paper loss just gets bigger and bigger. But here's the thing you have to understand. The loss already happened. The moment your investment dropped from 50 to 25,000, you lost the money. Selling doesn't create the loss, it just forces you to acknowledge it.
So if this bias is just baked into our DNA, are we just doomed to make these same mistakes over and over again? Well, thankfully, no. We might not be able to change our fundamental wiring, but we can absolutely build a system that protects us from its worst effects. We can treat the symptoms.
And this is where a strategy called hedging comes into play. Now, don't think of it like therapy that's going to change your personality. Think of it more like installing airbags in your car. It's a practical, mechanical way to structure your investments so that the symptoms of loss aversion, that panic, that fear, just can't do as much damage. Just look at the difference in these two mindsets. The emotional investor is on a total roller coaster, right? They're getting jerked around by every market dip, they're paralyzed by what they might lose, and they make fear-based decisions like selling at the absolute worst possible time. But the hedged investor, their experience is different. They've built in downside protection. They know from the start what their maximum loss can be. And just knowing that, it's enough to quiet that panicking, loss-averse voice in your head so you can actually make clear, rational decisions.
Now, I get it. The word hedge can be a little intimidating. For a lot of people, it conjures up images of hedge funds and all this complex, high-risk stuff. And that's a huge misconception we really need to clear up right now.
The funny thing is, the term hedge fund has become, well, it's just wrong. Ironically, a lot of these funds don't do much hedging at all. The way their fees are structured, they're actually incentivized to take massive swing-for-the-fences kinds of risks, which is the complete opposite of what a real hedge is supposed to be about. So let's just forget all that baggage. At its core, true hedging is incredibly simple. It is a powerful tool for controlling risk. That's it. It's about proactively building a portfolio that's protected from the kind of big, scary losses that send our emotional brains into a complete tailspin.
All right, so let's tie this all together. The big lesson here is that our own emotions, especially that deep, powerful fear of loss, are one of the biggest hurdles to investing well. We saw that this bias is strong enough to trip up even the best athletes in the world. But the solution isn't to try and become some emotionless robot. The solution is to build a smarter portfolio, one that uses a real strategy like hedging to control risk before it starts, which effectively treats the symptoms of our own messy human wiring.
And so that really leaves us with one final and, I think, crucial question. You can't rewire your brain. Your emotional reaction to risk is a fundamental part of who you are. So the real question isn't whether you can get rid of your emotions. The real question is, knowing they're there, have you built an investment strategy that's strong enough to handle them? A strategy that's built to protect you from yourself.
All right, let's get right into it. We all invest for a reason, right? To build something for our future. But what if the very habits we think are helping us are actually the things sabotaging our own goals? Today,
we're going to dig into the two biggest and, honestly, most costly mistakes that trip up almost every investor. And, more importantly, how you can avoid them for good. I might be showing my age here, but you gotta love a classic line from the movie Wall Street. Bud Fox asks Gordon Gekko this question, and man, it just cuts through all the noise. It's a great reminder that just piling up money for the sake of piling up money, that's a pretty empty game. The real question we should all be asking ourselves is, what's it all for? And this right here is the absolute bedrock we have to start from. Investing is just a tool. That's all it is. It's the engine that gets you to where you want to go, whether that's a great retirement, paying for college, or, finally taking that dream trip. The portfolio itself isn't the final destination. Let's just call it life goal investing. And for most of us, like 99% of us, these goals aren't happening next week or next month. They are way out on the horizon. We're talking 10, 20, even 30 years from now. And that reality, it demands a long-term mindset. It's really the only way this whole thing works. But this is where we run into a really interesting paradox, isn't it? We've got these ambitions that stretch out for decades, but our day-to-day behavior with our investments often feels like we're sprinting in a marathon. So why is there such a huge disconnect between what we say we want and what we actually do? And this slide just illustrates the problem perfectly. On one side, you've got the calm, rational, long-term plan. And on the other, you have this frantic, emotional, minute-by-minute behavior. It's right there, in the gap between those two things, that we find the first huge mistake. We're going to call it the tyranny of the ticker. You know what I'm talking about. It's that nonstop stream of flashing red and green numbers on your screen. It creates this totally false sense of urgency, making you feel like you have to react, that you have to do something right now. And this obsession, it kicks off a really vicious cycle. It all starts with just watching too closely. That constant flood of data will inevitably trigger an emotional reaction to every little dip and spike. And when you're acting from a place of emotion, you make impulsive trades, selling out of fear or buying out of FOMO. And the result of all that? High portfolio turnover, which study after study shows leads to worse returns. It is a completely self-inflicted wound. So here's the key takeaway. Your actions have to line up with your timeline. If your goal is decades away, your investment horizon needs to reflect that. You should be making investments that you're totally comfortable holding for at least 1 to 3 years and an absolute minimum of 6 months. You've got to give your strategy time to breathe without you micromanaging every single daily wiggle. Okay, so let's say you've managed to step away from the ticker. That is a huge win. But that brings us to the second and maybe even sneakier mistake, running an all-offense playbook. This is where you're totally focused on growth, on scoring points, with a complete disregard for protecting what you've already built. Let this one really sink in for a second, because it's so important. Capital that you lose is capital that cannot grow. It's money that can't be spent when you actually need it for that retirement home or that down payment. Every single dollar you lose is a dollar you have to earn all over again, just to get back to where you started, before it can even think about growing for you. Preservation is everything. I absolutely love this analogy. It's perfect. Most of us invest like a football coach who only drafts the flashy quarterback and the star wide receivers, but totally forgets to even hire a defensive line. Now, sure, that all-offense strategy might look amazing in the highlights, but it's a terrible way to win a championship. You'll get crushed. And the numbers here, they are just staggering. Fewer than 1% of retail investors actively use any kind of defensive or hedging strategy in their portfolios. Just think about that for a second. Almost everyone says they want to protect themselves on the downside, but almost nobody actually does anything about it. It's a massive gap between knowing what's smart and actually doing it. Now, this is where it gets really interesting. There was a fascinating study done by TD Ameritrade. They dug into their own customer data because they wanted to find the one thing, the one single thing that separated their most successful investors from their least successful ones. And what they found was, well, it was pretty remarkable. So what do you think it was? Really, take a guess. Did the best investors have more money to start with? Maybe more years of experience? Did they have some secret stock picking formula? The researchers looked at everything you could possibly imagine to find that secret sauce. And here's the crazy part. They found out that the top and bottom performers had the same average age. They had basically the same amount of money, their level of investment experience, identical. They even made the same number of trades every year in the same kinds of stocks and funds. I mean, by almost every metric you can think of, these two groups were clones of each other. So what on earth could possibly explain the difference in how much money they made? And this is the punchline. The single material difference was that the best performing investors used downside protection. That's it. They used simple tools like stop-loss orders or basic option strategies to put a safety net under their investments. They played defense. The worst performing investors did not. That was the whole ballgame.
So let's just unpack what that really means. The most successful investors weren't necessarily geniuses at picking all the winners. They were simply better at managing the losers. They had the discipline to actually think about what could go wrong, and they put a plan in place before it happened.
All right, so all of this brings us to the most important question of all. What does this mean for you? How do we take these lessons and turn them into a smarter, more resilient investment strategy? Let's build a new playbook. So let's boil it all down. If you don't remember anything else, remember these three things. First, make sure your investment timeline is serving your life's timeline, not the other way around. Second, treat your capital with the respect it deserves. Protect what you have, because lost money can't work for you. And third, understand that the real difference between winning and losing isn't just about picking great stocks, it's about playing great defense. And here's how that turns into a dead simple 4-step approach. Step 1, get crystal clear on your long-term goal. Why are you even doing this? Step 2, align your time horizon to match it. Think in years, not in days. Step 3, actively build in your defense. Ask yourself, what's my plan if things go south? And finally, step 4, monitor responsibly. Check in on your plan. Don't obsess over the price. So I'll just leave you with this one final thought to chew on. Take a good, honest look at your own strategy. Is it just playing offense, crossing its fingers and hoping for the best? Or is it truly built to win with both a powerful offense and a disciplined, thoughtful defense? Because the answer to that question could make all the difference in whether or not you actually reach your goals.
All right, let's get right into it. There's a question that I think hangs over every single person who puts their hard-earned money into the market. Is the whole game rigged? I mean, you look at these Wall Street behemoths with their supercomputers and armies of analysts, and it's tough not to feel like you're playing poker with someone who can see your cards. But what if I told you that their incredible power is actually what makes the market a fair place for you to play?
You know, this quote from John Nash, it really gets to the heart of it, doesn't it? Investing, at its core, is a competitive sport. For every winner, there's a loser. For every buyer, a seller. And if you walk onto that field unprepared, well, it can be a pretty unforgiving place. The stakes are incredibly high, so you absolutely have to understand the game you're playing. So, first things first, let's just acknowledge the elephant in the room. We have to talk about the sheer, mind-boggling scale of the big institutional investors. On the surface, it really does look like an advantage that's just impossible to overcome. Just try to wrap your head around this. These firms spend billions of dollars on technology just to process market data. Then they spend billions more to analyze it and execute trades in millions of a second. They get access to information that you and I will never see. And every single system, every algorithm, every hire is all designed for one single purpose, to gain an advantage. So yeah, it's no surprise that the average person might feel a little outgunned. And this right here, this chart really puts it in perspective. Look at this. A staggering 80% of all trading volume is what's called institutional program trading. You know, the high-frequency, computer-driven stuff? Another 17% is other institutional trades. And that little sliver left over? That's us. All of us retail investors combined make up a tiny 3%. We are a very small fish in a very, very big pond. But, and this is a huge but, this is where the entire story gets turned on its head. It sounds crazy, right? But that 97% institutional dominance, the very thing that seems so intimidating, it actually creates an environment that helps you. It turns these giants into your most powerful, if unexpected, allies. And here's the twist in all its glory. The disadvantage we feel, that we're outspent and have less information, that part is absolutely real. But the actual effect of all that high-speed, high-volume trading is a market that's way more efficient. All that activity helps the market figure out the fairest, most accurate price for a stock, what they call price discovery. And that, in turn, leads to better, faster, and fairer trade execution for everybody, including you.
Think back to that donut chart. If 97% of trades are between institutions, it means that most of the time, these giants are just fighting each other. They've got legions of the smartest people in the world whose only job is to not lose money. And because no institution can afford to get a bad deal from another one, their constant, ferocious competition is what creates a stable, liquid market. They literally keep each other honest.
And here's something crucial. Because of all this, protections for the little guy have been built right into the system. Our online brokerages have gone to bat for us and negotiated rules like this: automatic fill requirements. It's basically a rule that says for small trades, the kind you and I make, market makers have to give us the going market price. It's a safety net woven into the fabric of the market.
So let's just completely flip the script on this. The market is not rigged against you. The incredible truth is that it's kept remarkably fair and efficient because of those same powerful institutions we see as our competition. Their own self-interest accidentally creates an orderly, reliable market where you can step in and confidently build your future.
Okay, so if we can feel confident that the game is fair, the next question is obvious. How do we play it? And how do we win? That brings us to the investor's toolkit. 3 classic cornerstone strategies that people have been using for decades. Let's see how they're holding up. First up, we have indexing. The old standby. The idea is brilliant in its simplicity. Don't try to beat the market, just be the market. You buy a low-cost fund that tracks something like the S&P 500 and you ride the wave. It's cheap, it's tax-efficient, and for a long time, it's been a fantastic approach. But there's a problem. In the last decade or so, with interest rates so low, the returns from major indexes have often struggled to even keep pace with inflation. By itself, it might not get you to your goals anymore.
All right, strategy number 2, asset class allocation. This is the heart of what's called modern portfolio theory. You know, the classic advice, don't put all your eggs in one basket. You diversify your money across different things, stocks, bonds, real estate, cash, because they don't all move up and down at the same time. It's all about managing risk. But again, look at the recent reality. Even pretty aggressive portfolios built this way have been pulling in maybe 3 or 4% a year. And, well, that's just not going to cut it for most of us.
And that brings us to our third tool, defensive hedging. The best way to think about this is like buying homeowner's insurance for your portfolio. Simple as that. You're buying things that are specifically designed to go up in value when the rest of your portfolio goes down. It's an amazing way to protect yourself from a crash. But just like your insurance policy, it's not free. There's a cost, a premium. And when the market is climbing, that premium is a constant drag on your returns. So for that reason, it can't be your only strategy.
So what do we have? We've got 3 solid strategies, but each one has a pretty serious flaw in today's world. This brings us right to the core idea of this whole explainer. True strength, real power, doesn't come from picking just one of them. It comes from combining all 3.
See, each of these strategies, indexing, asset allocation, hedging, they're like individual ingredients. They're fine on their own, but they're incomplete. The real magic, the breakthrough, happens when you stop thinking of them as a multiple-choice question and start seeing them as essential components of one single, unified system.
And here's what that looks like. We call it the buy and hedge strategy. Step 1, you lay down your foundation. That's your cheap, efficient indexing. Step 2, you build the structure on top of that foundation. That's your diversification from asset class allocation. And then step 3, you put a protective shield around the whole thing. That's your defensive hedging. See, they're not options, they're layers. They work together.
And when you weave them together like this, something amazing happens. The weakness of one strategy gets canceled out by the strength of another. The authors of the work we're drawing from have been using this exact philosophy since 2008. Yeah, right through the great financial crisis, and have found that it produces excellent results by turning those individual weaknesses into one hell of a collective strength.
So why? Why does this combination work so well? Is it just some clever trick? Not at all. It's effective because it is built on the fundamental, non-negotiable truths of investing, what you might call the immutable laws of the game.
Now, these aren't my opinions or some hot new theory. These are just the laws of financial physics. They are the unavoidable conditions that every single investor, from the person with $100 to the hedge fund with $100 billion, has to deal with to be successful. You can't ignore them.
And here they are. Number 1, capital lost is capital that cannot grow. It sounds so obvious, but it's the most violated rule there is. Number 2, risk is the input and return is the output. You can't get one without the other, period. Number 3, emotion is the enemy. Fear and greed have wiped out more wealth than any bear market in history. Number 4, volatility is kryptonite. Big swings make it mathematically harder for your money to compound. And number 5, the return that matters is after-tax return, because at the end of the day, it's not what you make, it's what you keep.
So here's the crucial point. When you start to see the market through the lens of these 5 laws, the buy and hedge strategy isn't just a good idea, it becomes the only logical conclusion. Indexing gives you growth, allocation manages your volatility, and hedging directly addresses that first and most important law, protecting the capital you simply cannot afford to lose. These laws don't just suggest this strategy, they practically demand it.
And that leaves us with one final thought to chew on, and it comes from that second law. We are all completely obsessed with our return, the output. But if return is the output, what is the most important input that we need to be managing? Something to think about. Thanks for tuning in.
All right, welcome to The Explainer. Today, we're jumping into a law of investing that is so fundamental, it's almost hiding in plain sight. But here's the thing, don't let how simple it seems fool you. Really getting this one idea can totally change the way you think about building wealth. It can shift your whole focus from just chasing big gains to something a lot more powerful.
You know, let's start with a feeling I think we all hope to never have. That just gut-wrenching moment when you realize you've lost a serious amount of money. This line from the movie, it just nails that feeling, doesn't it? It's that deep-seated fear that years of saving could just poof, evaporate. And that fear, it sits in the back of every investor's mind for a really, really good reason. And it's that fear, right? That visceral feeling of what it's like to lose that leads us straight to what our source material calls the first immutable law of investing. You can think of this as the bedrock, the absolute foundation that should be underneath every single decision we make with our money.
Now, I'm going to be honest. When you first hear this law, you might just think to yourself, well, duh. The source material has this great little acronym for it, a BGOTO, a blinding glimpse of the obvious. But trust me, you're going to want to stick with me here, because like a lot of really profound truths, its real power is kind of hidden in just how simple it is.
Okay, so here's how we're going to break this down. First, we're going to lay out the law itself. Simple enough. Then we'll get into the incredible power of compounding, the engine this whole law is designed to protect. After that, we're going to look at the pretty shocking math of a market meltdown, see the hidden benefit of avoiding disaster, and then we'll tie it all together to see how protecting your money is actually what creates real, long-term growth.
So, let's get right to it. What is this law that's both a blinding glimpse of the obvious and, at the same time, this super profound investment truth? Well, it's the whole idea behind a strategy our source calls buy and hedge.
Why this law is so important? It really clicks when you understand what hedging is. As you can see here, it's really just building some protection into your portfolio. Think of it like insurance for your investments. We all get why we have car insurance or home insurance, right? Well, hedging is just applying that same kind of thinking to our money. And the reason why that protection is so critical, it all comes back to the law itself.
And here it is. Capital that is lost is capital that cannot grow. Just let that sink in for a second. Every single dollar you lose isn't just a dollar that's gone. It's a worker that's been fired. It's a soldier that's been taken out of your army permanently. Its potential to go out there and fight for you, to earn more, to grow, that potential is just gone. Forever. This is the core, absolute truth we're digging into today.
So, if every dollar we lose is a soldier lost, what's the battle we're trying to win here? What is this future growth potential that we're so desperate to protect? To get that, we've got to look at the single most powerful force for creating wealth in the entire financial world.
And that engine, of course, is compounding. It's this process where your growth starts to build on itself. Your earnings start having their own babies, and then those babies start having babies. It just creates this amazing chain reaction, this snowball effect that can turn a pretty small sum into an absolute fortune if you give it enough time. It is not an exaggeration to call this one of the most powerful forces an investor has.
And hey, don't just take my word for it. Warren Buffett, probably the most successful investor ever, points right to it. He famously said his insane wealth came from, living in America, some lucky genes, and compound interest. He gets it. The real secret is to get that compounding engine running, and then your number one job becomes doing whatever you have to do to never, ever let it stop.
And that's the whole point, isn't it? That amazing compounding engine, it only works on positive numbers. A big loss doesn't just tap the brakes, it throws a giant wrench right into the gears. So now let's look at the cold, hard math of a meltdown to see just how destructive that wrench can be. To really drive this home, our source gives us two fascinating studies. Let's start with a little thought experiment. Imagine you put $100,000 in the market at the start of 2001. Now, what if you had a magic wand and you could just sidestep the 10 absolute worst trading days for the S&P 500 over the next decade? Just 10 days. How much of a difference could that possibly make?
Okay, just take a look at these numbers because the difference it's just staggering. If you just stayed in, took all the hits, your 100 grand grow to about 113,000. Okay, a small gain. But in our magic scenario, just by missing those 10 awful days, 10 days out of more than 2,500 trading days, your portfolio would have shot up to over $232,000. I mean, to put a fine point on it, that's not a small difference. The portfolio that was protected didn't just do a little bit better. It outperformed the market by a massive 119%. It more than doubled the final result just by playing defense and missing a few catastrophic moments. Now, of course, I get it. Nobody has a crystal ball. Nobody can predict the 10 worst days. It's impossible. So let's check out the second study, which uses a much more realistic time frame. What if instead of specific days, you could have protected your portfolio during the 4 worst quarters of that same decade? A quarter is 3 months. That's a much more manageable chunk of time to think about risk.
And once again, the visual here just says it all, doesn't it? The bar on the left, that's the regular S&P 500 portfolio. The bar on the right is the one that managed to sidestep those 4 disastrous quarters. And the result? It's almost the exact same as the first study. You nearly double your final value.
So this data is incredibly powerful. But it also begs a really important question. What's the real lesson here? I mean, seeing these numbers is one thing, but what are we supposed to do with this information? What's the hidden benefit we're supposed to be seeing? So is the takeaway here that we should all be trying to time the market? Is this a call to action to try and predict when things are going to go bad and constantly be jumping in and out of our investments?
The source is incredibly clear on this point. Absolutely not. Trying to time the market is a fool's errand. It's a loser's game. The whole reason for showing you this data is not to turn you into some frenzied day trader. It's to show you in vivid color the sheer, raw, destructive power that a major loss has on your long-term compounding machine.
See, the real lesson, the most important thing to get, is that the benefit of avoiding a huge loss is actually a 2-for-1 deal. First, the obvious one. You avoid the initial damage. You don't lose the money. But second, and this is the crucial part, you preserve your capital base. You keep more of your soldiers on the field, which means that when the market does turn around, you have a much larger army ready to charge ahead and capture all that upside. That's the compounding effect of preservation.
And all of this, it brings us right to the ultimate conclusion, the key takeaway from all of this. This whole analysis points to a really powerful, and for a lot of people, a kind of counterintuitive shift in perspective about what actually drives long-term success in investing. So let's just recap the big ideas here. First, never ever forget that immutable law. Capital that is lost cannot grow. Second, you have to recognize that compounding is this precious engine that you must protect no matter what. And third, you got to understand that the real gain from avoiding a big loss isn't just the money you save today, it's all the compounded growth you set yourself up for tomorrow on the money you manage to protect.
You know, ultimately, this just flips the common wisdom about investing completely on its head. We are so often taught that success is all about picking the next Amazon, the next big winner, playing great offense. But what this analysis is screaming at us is that real, enduring, long-term success might have a whole lot more to do with just skillfully avoiding the big losers. It's about valuing your defense just as much, if not more than your offense.
So I'll just leave you with this provocative question to kind of chew on. What if the primary focus of your entire investment strategy just shifted? What if before you ever asked yourself, how can I maximize my gains, you first asked, how can I best protect my capital from a major loss? Because the answer to that second question, well, that might just be the real secret to winning in the long run.
You know, there's a fundamental truth in investing that's so easy to miss. But once you see it, once it really clicks, man, it changes everything. And it's this. Risk is what you actually buy. The return? Well, that's just what you hope for. Let's dig into why this simple little shift in perspective is so incredibly powerful.
I love this line from the Wall Street sequel because it just perfectly sets the stage. We tend to think of risk as this bad thing, right? Something to avoid, a dangerous side effect. But what if it's the main event? What if it's the engine of progress and the true currency of the markets? It's not just some byproduct of investing. No, it's the very thing we're paying for.
So here's our game plan for this explainer. First, we're going to confront our collective obsession with returns. Then, we'll get to the real heart of it. What are you actually buying when you invest? From there, we'll uncover where your real power lies, understand the unbreakable link between risk and return, and finally, we'll lay out the path to becoming a true risk manager.
All right, first up, our obsession with returns. I like to call this the seduction of the report card. You know that feeling, right? That little dopamine hit when you log into your brokerage account and see all that green? It's like getting an A+ on a test. It's instant validation that you're smart, you made the right call, and your wealth is growing. It's a powerful and, let's be honest, a pretty addictive feeling. But here's the critical question. Is that number really the right thing to be focused on? I mean, think about it. In almost any other part of life, we know that obsessing over an outcome you can't directly control is a recipe for failure. A farmer can't control the weather, so they focus on what they can control, the soil, the irrigation. A coach can't control the final score, so they focus on practice and strategy. Why on earth should investing be any different?
And that brings us to the core of this whole idea. Let's peel back the layers of a simple investment and really uncover the shocking truth of the transaction. What are you actually buying?
So let's do a super quick refresher here. Why do stock markets even exist? Well, it's pretty simple, really. Companies need money, capital, to grow. They need it to build factories, launch new products, or acquire their competitors. And they raise that money by selling off tiny little pieces of their business to investors, to people like you and me.
So when you click buy on a stock, you're not just buying some ticker symbol or a lottery ticket. You are purchasing a real, tangible, even if it's minuscule, piece of that actual company. You become a part owner. That is the reality of what's happening.
And in this right here, this is where the big disconnect happens. Our expectation is that we're buying a future return. It's like we're putting money into a machine that's going to spit out more money later. But the reality is completely different. The only thing you are guaranteed to receive the moment you click buy is the company's present-day risk.
Just let that sink in for a moment. All you bought was risk. That's it, period. When you purchased that security, the one and only thing that was certain about that transaction was that you were now the proud owner of that company's risk. The return? That's just a possible future outcome. The risk is what's on your books right now, today. And you might ask, well, why is that? It's because, as a small retail investor, let's be real, your stake is tiny. You can't call up the CEO and give them advice. You don't control their strategy, you don't control their marketing, and you sure don't control their R&D budget. Your potential return is entirely 100% dependent on a management team you've probably never met executing a plan you didn't create. You have simply bought into the risk that they get it right or wrong.
And this chart here perfectly illustrates the range of possibilities you just bought into. Maybe you get lucky and hit exceptional returns. Awesome. Or maybe the company just has poor results. Maybe it stagnates for years, tying up your capital and going nowhere. Or in the worst case scenario, it goes bankrupt and you lose everything. When you buy that stock, you're buying a ticket to one of these outcomes with absolutely no guarantee which one it's going to be.
Now, I know this might sound a little bleak, maybe a bit depressing, but it's not. It's actually incredibly empowering. Because once you accept what you can't control, you can finally shift your focus to where your real power is. And that's what this next part is all about.
Let's try to reframe investing with this really simple equation. Think of risk as the input. It's the only ingredient you actually get to control. You decide which risks to add to your portfolio, how much of each to use, and how you combine them. The return? That's just the output. It's the result, the measurement of how well your chosen inputs performed.
And that is the crucial shift. That's the whole game. You gain control not by chasing or hoping for a specific output, but by meticulously, carefully designing the input. Your power as an investor isn't in wishing for returns, it's in deliberately choosing and managing the risks you are willing to own. That is the only lever you can actually pull.
Okay, so if risk is the input we control, we have to understand its fundamental nature. And this brings us to what you could call the iron law of investing, the unbreakable link between risk and return. This relationship is as fundamental as gravity. It's just a law of financial physics. There is no such thing as a high return for low risk. It just doesn't exist in a functioning market. If you want the safety of lower risk, you must accept the likelihood of lower returns. And if you're aiming for those higher potential returns, you absolutely must be willing to take on more risk, which, and this is crucial, also means accepting the potential for bigger losses. And you know what? This gives you a built-in fraud detector. Anytime, and I mean anytime, you hear a pitch that promises high returns for low risk, you need to run. That is the foundational lie behind nearly every financial scam in history, from old-school Ponzi schemes to modern crypto shills. It violates the basic physics of the market. They're not letting you in on a secret, they're trying to take your money.
I really can't stress this enough. Risk and return are welded together. They are two sides of the exact same coin. Trying to separate them is one of the most dangerous and costly mistakes an investor can make. You forget this lesson at your own peril. It's that simple.
So what do we do with all this knowledge? How do we actually put this into practice? Well, in our final section, we're going to explore the path to taking back control by becoming a true risk manager.
The ultimate goal here is a complete identity shift. You have to move from being a return chaser, someone who's constantly on a treadmill searching for the next hot stock, to becoming a risk manager. Your job is no longer to guess the future, but to build a portfolio where the risks are understood, measured, and intentionally chosen.
Now, one approach that's talked about in the source material is called the buy and hedge method. And without getting into all the nitty-gritty details, the core idea is simple. Instead of just buying an asset and hoping for the best, you also strategically add positions that can offset potential losses. It's a philosophy built not on predicting the future, but on building a structure that can withstand multiple futures. It's all about modifying and controlling the risks you own, which is the very essence of true portfolio design.
So, let's bring it all home with the key lessons. First, and most importantly, risk is the input you can control. Return is the output you can't. Second, if you aren't actively measuring and managing risk, you don't really have control over your portfolio. You're just along for the ride. And third, never ever forget that unbreakable link between risk and return.
So I'll leave you with this one question to really reflect on. Take an honest look at your own portfolio. Is it built on the simple hope that things will just go up? Or is it built on a solid, deliberate understanding of the specific risks you have chosen to buy and own? The answer to that question will define your entire journey as an investor. Thanks for joining this explainer.
You know, in investing, we spend so much time poring over the data, analyzing companies, staring at charts, trying to predict what the economy is going to do next. But what if I told you the single biggest threat to your financial future isn't out there in the market at all? It's actually, well, it's right between your ears. Yeah, it's not a bad stock pick or some hidden fee that's most likely to completely wreck your plans. It's our own emotions. They can hijack a perfectly good strategy and just turn it into a total mess of panicked decisions. So today, we're going to do something a little different. We're going to treat this like an investigation. We're going to look at the hard data and prove, once and for all, why emotion is the real enemy of your wealth. All right, let's get into it. And yeah, I know what you're thinking. We're starting with Yoda. But stick with me here, because believe it or not, this quote is spot on. This piece of wisdom isn't just for battling the dark side in some sci-fi movie. It is a perfect, almost chillingly accurate description of the destructive cycle that's driven by the two most powerful forces in finance, the two forces that are always at war for control of the markets. And those two forces, well, they're greed and fear. The way I like to think about it is they're like the weather patterns of the market. Greed, that's the slow, steady updraft. It's that feeling that pushes markets higher and higher, fanning the flames of, oh man, I gotta get in on this, during those long, steady climbs. And then there's fear. Fear is the hurricane. It's the sudden, violent downdraft that just fuels absolute panic and drives those gut-wrenching, portfolio-crushing drops we all know and dread. So the big question is, which one is more powerful? I mean, you turn on the TV, and you'll hear the so-called experts debate this thing till they're blue in the face. Is it the slow burn of greed or that sudden jolt of fear? Well, you know what? We're not going to just offer another opinion today. No way. We're going to treat this like a real investigation. We're going to push the talking heads to the side, open up the case file, and look at 2 decades of hard data to find a real, definitive answer. Okay, so before we dive into the evidence, we need to talk about fear's secret weapon. Seriously, it's a fundamental psychological principle, a little quirk in how our brains are wired that gives fear this totally unfair advantage in the fight for your money. If you don't get this one concept, none of the data we're about to look at is going to make a whole lot of sense. It's a concept called loss aversion. And here's the deal in plain English. The pain of losing, say, $100 feels way more intense than the pleasure you get from gaining that same $100. I mean, some studies show it's like twice as powerful. And this isn't some kind of personal flaw, okay? It's a survival instinct that's hardwired into our brains. But when you apply that to the stock market, it makes us absolutely desperate to avoid losses. And that desperation, it's what leads to that catastrophic decision to sell everything at the absolute bottom. Okay, so now that we've got that key concept of loss aversion locked in, let's open our first evidence file. We're going to put the market under the microscope here and start by looking at the most extreme single days. We're talking the absolute best and the absolute worst days for the S&P 500 over a 20-year span. Now, this is really interesting. When you first look at these numbers, things seem pretty even, right? I mean, the average of the top 10 best days is a gain of about 7.7%. The average of the 10 worst is a loss of about 7.3%. On the surface, you might even say, hey, looks like a draw. Maybe greed has a tiny little edge. But I'm telling you that first glance is completely, totally misleading. Because the real story, well, the real story is in the dates. The second you stop looking at the percentages and you actually look at when these days happened, a much darker, much more revealing story starts to come out. And this, right here, is where the case for fear's dominance really starts to build. This is just incredible. Get this. 6 of the market's 10 best days happened in the fall of 2008, right in the middle of the global financial crisis, one of the worst market crashes in modern history. In fact, all 10 of these so-called best days were really just these tiny little rebound days, these desperate gasps for air, right in the middle of absolute catastrophic meltdowns. Trust me, nobody was celebrating on these days. They were just feeling a tiny moment of relief from the absolute terror of losing everything. All right, so the daily data is pretty eye-opening for sure, but let's be real. Most of us aren't day traders, right? We're in this for the long haul. That day-to-day noise can be a huge distraction. So for our next piece of evidence, let's pull the camera back. Let's zoom out from the individual days and look at the entire market cycles of fear and greed. So here's what we did for this part of the investigation. We looked at every single time the market moved 10% or more, up or down, over a 20-year period. That gave us 51 different periods to analyze. And we measured one thing. How long did it take to go from the bottom to the next top? That's the greed cycle. And how long did it take to go from a peak down to the next bottom, the fear cycle? We're looking for the speed of each emotion. And the results, honestly, they're just staggering. On average, for the market to make a major climb, to go from the bottom of a crash to a new peak, it took 224 days. That's over 7 months. Think about that. That's the pace of greed. It's a slow, steady, patient grind higher. But what about the trip down? How long did it take to go from a peak to a trough, to fall into a correction? On average, just 55 days. Less than 2 months. That is the shocking, brutal speed of fear.
I mean, this chart just lays it bare. It's undeniable. The market is completely asymmetrical. You've heard the saying, right? The market takes the stairs up, but it takes the elevator down. And here's the proof. Fear works almost 4 times faster than greed. It's a totally different kind of force. It's not a steady climb, it's a wrecking ball.
And it gets even crazier when you look inside those moves. To get 80% of the total gain on the way up, it took about 179 days. But to experience 80% of the total loss on the way down, that happened in just 44 days. The pain of a fear-driven drop is concentrated into this incredibly short, sharp window. I mean, years of your hard-earned gains can literally be wiped out in just a few weeks. So, after looking at the evidence from the craziest single days, after analyzing the long-term market cycles, after seeing the raw speed and violence of the falls compared to the climbs, well, our investigation is coming to a close. The case file is full, and the verdict is in.
The debate is over. Fear wins. And based on what we've just seen, it is not even close. The data doesn't just suggest that fear is more powerful, it screams it. In the battle for your portfolio, just realize, it's not a fair fight. Greed is showing up with a scalpel, and fear is bringing a chainsaw.
So let's just recap what our investigation has laid out. It's pretty clear. Market gains are slow, they're steady, they're patient. Market losses are the total opposite, sharp, fast, and violent. And it all comes back to that loss aversion we talked about. It supercharges fear and makes people hit the sell button with a speed that greed just can't compete with. And the most important part, this isn't some rare, unpredictable event. This is a fundamental feature of how markets work, and you have to plan for it.
All right, so why does any of this matter?
why did we just go through this whole investigation? Well, there's that famous quote from Sun Tzu, right? If you know the enemy and know yourself, you need not fear the result of 100 battles. And now, after looking at all this data, we definitely know the enemy.
And that brings us to maybe the single most important point of this entire discussion. Trying to fight an emotion that we've just proven is 4 times more powerful than its opposite just by using willpower, well, that's a losing game. You just can't grit your teeth and tell yourself to be brave when the market's in a freefall and your retirement is evaporating before your eyes. It doesn't work. You need a system. You need a structural defense, not just, trying to be tougher.
And that system, that structural defense, has a name. It's called hedging. And all that means is building a portfolio that is designed from day one to reduce the impact of those wild swings and limit the kind of dramatic losses that set off our fear response. The whole point is to remove the need to make a panicked emotional decision, because your portfolio was already built for the storm long before the first raindrop fell.
So I want to leave you with one final thought. We know with 100% certainty that fear is coming back. It's not an if, it's a when. That sick, panicked feeling in your stomach during the next big crash, that's a guarantee. So the only question you really have to ask yourself is this: is my portfolio actually built for it? Your emotions are guaranteed. Is your portfolio?
We all want our investments to grow. It's why we're in this game. But there's this powerful, often misunderstood force that's constantly working against us, and that's volatility. It's kind of like a silent thief that just erodes our returns over time. And I want you to think of it this way. If compounding, that magical force of growth, is your portfolio Superman, then volatility is its kryptonite.
Now, Bette Davis probably wasn't talking about the stock market when she said that, but she might as well have been, right? Those bumps she mentioned, that's what we call volatility. And honestly, understanding how those bumps secretly sabotage your money is one of the single most important lessons in all of investing. So to really get a feel for this, we're going to do a little challenge. I want you to think of it like one of those blind taste tests, but for investment portfolios. I'm going to show you 2 different options, and I just want you to decide which one you'd rather have your money in. You ready? Let's do this. Okay, so take a look. At first glance, these 2 portfolios look like they should end up in the same place. Portfolio A has these wild swings, right? Down 30%, then up 30%. But Portfolio B is much, much smoother. Down 10, up 10. Now, on paper, the average return for both of them is 0. So if you start with $100,000 in each, which one do you think comes out ahead after 4 years?
The intuitive answer, the one that your gut tells you, is that they end up the same. And it makes perfect sense, right? A 30% loss should be canceled out by a 30% gain. But I'm telling you, that gut feeling, that intuition, is dead wrong. The actual math of investing tells a completely different story. So let's look at the smoother ride first. This is Portfolio B. With those smaller, less dramatic swings of -10 and +10%, you end the 4 years with $98,010. Okay, so a small loss, but you're very, very close to breaking even. Now, what about that wilder ride?
Wow, Portfolio A, the one with the big swings, finishes with just $82,810. I mean, that is a staggering difference of over $15,000. And remember, the average annual return was exactly the same. So what on earth is going on here?
Here is the simple, absolutely brutal math that most people miss. Losses and gains are not symmetrical. They don't cancel each other out. When your $100,000 portfolio loses 30%, you're down to 70 grand. Okay? Now, a 30% gain from that new, lower starting point only gets you back to 91,000. You actually need a 42% gain just to get back to where you started. Volatility digs a hole that is incredibly hard to climb out of.
And that was just test number 1. But you might be thinking, okay, that's one scenario. But what if we change things up? Well, that's exactly what we're going to do. Let's really put this principle through its paces and see just how deep this volatility rabbit hole really goes.
All right, for our second test, let's just flip the order of the returns. What if the volatile portfolio A starts with a big 30% gain? The common thinking is that this gives you a nice cushion, right? A head start that helps you weather the losses that come later. But does it actually make a difference in the end?
Nope, not at all. It feels like it should, I get it, but it just doesn't. The final numbers are exactly the same as in our first test. See, a portfolio that starts with a gain, well, it simply has more money to lose in the next year. A 30% loss on a bigger number is a bigger loss in terms of dollars. The sequence of your returns does not change the destructive math of volatility.
Okay, let's see if we can rescue Portfolio A.
For our third test, we're going to add a fifth year. So, Portfolio B, the smooth one, gets a flat 0%. But we're going to give Portfolio A, the wild one, a huge 15% boost. Surely that has to be enough to close the gap and finally come out on top, right?
And the answer is still no. It's amazing, isn't it? Even after a fantastic fifth year, Portfolio A only gets to just over $95,000. The smoother, less volatile Portfolio B is still ahead with $98,000 even without that big final year gain. This just shows you how deep of a hole that high volatility can dig. The damage from those early years is so significant that even a really powerful recovery can't fully undo it.
So far, we've only looked at portfolios that have some losses in them. But what about a scenario where everything's positive? So here we've got Portfolio C with a nice steady 10% gain each year, and Portfolio D, which is more volatile, swinging between 20% and 0. Now both of them average out to a 10% annual gain. So, does volatility still matter even when you're always in the green?
Of course it does. The steady Portfolio C ends up with over $2,400 more than the volatile one. Now the difference is smaller here, but it proves a fundamental point. Volatility acts like a hidden tax on your returns. Even in a market that's always growing, a smoother ride will almost always leave you with more money in your pocket simply because it allows the power of compounding to work its magic more efficiently.
Okay, so we've clearly seen the what. That volatility hurts your returns no matter how you slice it. The evidence is pretty overwhelming. But, that's not enough. To truly protect ourselves, we have to understand the why. Why is this force so uniquely damaging to our long-term financial goals?
This analogy right here really gets to the heart of the matter. I want you to think of compounding, that incredible process where your earnings start generating their own earnings as the Superman of investing. Truly, it is the single most powerful force for growing wealth over time. But high volatility is its one great weakness. It's the kryptonite that drains compounding of its power and stops it from working.
But here's the thing. The damage isn't just about the raw numbers on a spreadsheet. The kryptonite effect of volatility is so dangerous because it actually attacks your portfolio on 3 different fronts at the same time. And understanding all 3 of them is the absolute key to building a real defense.
So we've already proven the first one, right? The cold, hard mathematical damage that volatility does to your returns. But it also attacks you on 2 other fronts. First, it wages a psychological war, messing with our instincts and tricking us into making terrible decisions. And then it has a logistical impact, creating this hidden financial cost just to protect your money from the first 2 attacks.
Now, this psychological part, it is huge. We humans were all hardwired with something called loss aversion. What it means is that the pain of losing $1,000 feels about twice as bad as the pleasure you get from gaining $1,000. So when markets get volatile and your portfolio is swinging around like crazy, that pain becomes really intense. It makes your stomach churn, and it drives you to make emotional decisions, like selling at the absolute bottom, which is the worst possible thing you can do.
And finally, there's that logistical impact. So protecting your portfolio from big losses is called hedging, and it works a lot like insurance. And just like a driver with a history of accidents pays more for car insurance, an investment with a history of wild price swings costs more to insure. So higher volatility literally makes the tools you'd use to create a smoother ride more expensive, which creates a direct drag on your performance.
Okay, so we've seen the math, we've seen the psychology, we've seen the logistics. We understand now how this kryptonite works. So what does all this mean for you and for your money? Let's try to boil this all down into the core lessons you can actually take away from this.
So let's just put it all together. Volatility is so much more than just a bumpy ride. It's a direct tax on your returns. It's the kryptonite that weakens and neutralizes compounding. It's a psychological trigger that pushes us to make bad decisions. And it's a hidden cost that makes protecting your money more expensive. Taming volatility isn't just about sleeping better at night. It's about having more money in your account when you wake up in the morning.
And all of that leaves us with one final and I think crucial question to think about. When you look at your own investments, what is the real goal? Are you just chasing the highest possible gains you can get and accepting the wild swings that come along with it? Or is your strategy actually focused on minimizing the damage from that bumpy ride, knowing that a smoother journey often leads to a much better destination? The answer to that question could change everything.
All right, welcome back. Let's talk about something that's, well, just as certain as death. and that's taxes. We love to get excited about returns, about finding that next great stock, about timing the market just right. But you know who's always there, right behind every single gain? The tax man. And figuring out his role isn't just for accountants. It is a fundamental, you could even say an immutable law of investing. So yeah, let's get into it.
I mean, you just have to love this. If the dude, a guy whose main worries in life are his rug, his bowling night, and where his next white Russian is coming from, if he's worried about getting bumped into a higher tax bracket, that's a pretty big signal, right? It tells you that every single one of us who's serious about our money needs to be paying close attention. It's funny, for sure, but it's also the perfect way to ease into a really important subject.
Okay, so here's the plan. First, we're going to nail down the one and only number in your portfolio that actually matters. Then, we'll take a look at just how much ignoring taxes can really cost you, and we'll even dive into a specific problem for folks who hedge. From there, we'll talk about making a crucial mindset shift to become a truly tax-smart investor, and then, of course, we'll wrap it all up with your key takeaways. All right, let's get right to the heart of it. We're about to talk about what our source material calls an immutable law of investing. And look, this isn't just a tip or a nice little suggestion. This is a core principle. Get this right, and it can supercharge your long-term success. Get it wrong? Well, it can really hold you back.
And there it is. Simple as that. Only after-tax returns matter. It's so easy to say, but it is so, so powerful. You know that big, flashy number you see on your statement before taxes? It's kind of an illusion. It's not real money yet. The only number you can actually spend, the only number you can use to build your life, is what's left after the taxman has taken his cut. What you keep is the only thing that counts.
So what are we talking about, really? Your after-tax return. That's your take-home pay from your investments. It's the real cash you have left to fund your actual life. I mean, think about it for a second. Your retirement, paying for college, buying that house you've been dreaming of, all of those big life goals, they are all paid for with after-tax dollars. That's why this number, and this number alone, is the ultimate scorecard for how you're doing as an investor.
So why do we go so far as to call this a law? Well, the first reason is pretty straightforward, if not a little painful. Uncle Sam's slice of the pie is really, really big. It's big enough to seriously change your final result. Let's break down what that actually looks like. Now, this is where it gets really interesting, because you can see the government drawing a clear line in the sand. If you hold something for a year or less and sell it for a profit, that's a short-term gain. And guess what? You pay taxes on that at the same high rate as your paycheck. But if you just hold on for more than a year, it becomes a long-term gain, and you get rewarded with a much, much lower tax rate. The system is basically screaming at us to be patient. And this chart just makes it crystal clear, doesn't it? For a pretty typical investor, that short-term gain could get hit with a 33% tax rate, maybe even more. Now compare that to the 15% for the long-term gain. It's less than half. We are not talking about pocket change here. This is a huge, massive difference that dramatically changes how much money actually ends up in your pocket. So what's the big picture damage here? Well, it's pretty simple. Every single extra dollar you send to the government in taxes today is a dollar that's no longer in your account, working for you 24/7. It's a dollar that can't be reinvested, it can't earn more dividends, and it can't benefit from that eighth wonder of the world we call compounding. A higher tax bill today literally means a smaller retirement fund tomorrow. It's that direct. Okay, so let's zoom in on a specific strategy where this law becomes absolutely critical. The second major reason this matters so much hits home for anyone using what's called a buy and hedge strategy. Because as we're about to see, the way this strategy works creates a very unique and often very expensive tax headache. So when we say hedging here, what do we mean? Well, think of it as a strategy to protect your portfolio from big drops. But here's the catch. It's not one of those set it and forget it deals. To keep that protection active, you have to constantly make adjustments, buying and selling things as the market zigs and zags. And every single one of those little adjustments, yep, it's a taxable event. This slide just lays out the chain reaction perfectly. It starts with the need for these regular transactions to keep your hedge working. That, in turn, almost guarantees you're going to be creating a lot of frequent, short-term gains. And as we just learned, what happens to those? They get slammed with your highest possible tax rate. So a strategy that you're using for protection can accidentally create this massive tax drag on your portfolio. Okay, so we've laid out the problem. The tax man is coming, and he's coming for a big piece of the action. So what do we do about it? Well, this isn't about doing anything shady. this is about making a really important shift in how you think. It's about deciding to become a tax-smart investor. You know, this question actually comes up. It's almost like a mental block for some people. We're all taught that it's our civic duty to pay taxes, and it absolutely is. So does that mean that trying to legally and strategically lower your tax bill is somehow unpatriotic? And the answer to that is a clear and resounding no. Here's how to think about it. Your duty is to pay every single penny of tax that you legally owe, but you have zero obligation, patriotic or otherwise, to voluntarily leave a big tip for the IRS. Smart tax planning isn't tax evasion, it's tax efficiency. It's just being smart. In fact, if you look closely, the tax code itself is basically a giant instruction manual from the government. It's designed to reward you for doing things they think are good for the country. That lower tax rate for long-term investing, that's an incentive to be a stable, patient investor. All those tax breaks you get for your 401k or your 529 plan, those are incentives to save for your own future. The government is literally showing you the path to a lower tax bill. So here's the bottom line. Planning for tax efficiency isn't about finding sketchy loopholes. It's about playing the game by the rules that the government itself created. It is a core skill for any serious investor. A smart investor doesn't just think about what to buy, they think about how to own it and where to hold it to maximize the real money they get to keep. Whew, okay, we've gone all the way from the dude to the nitty-gritty of capital gains. So let's take a moment and just boil all of this down to the most important things you need to remember as you walk away from this.
Okay, number one, always, always, always remember that your life goals are paid for with after-tax money. That's your true north. Number two, the gap between short-term and long-term tax rates isn't small. It is a game changer. 3, be really mindful that some strategies, especially hedging, come with a built-in tax cost you have to manage. And finally, number 4, pulling it all together. Tax planning is not something you do later. It's a critical part of being a successful investor from day one. At the end of the day, it really comes down to this one simple truth. Understanding how taxes affect your investments isn't some expert-level topic. It is absolutely fundamental. It's just as important as knowing what a PE ratio is. This is a powerful tool, and it absolutely belongs in every single investor's toolkit. So, I'll just leave you with this one question to think about for your own money. Where is it really going? Is every one of your investment dollars working as hard as it possibly can to fund your future, your dreams, your retirement? Or are you, without even realizing it, just funding a bigger tax bill than you need to? The power to change that? Well, that's entirely in your hands. All right, let's dive into one of the most powerful, yet honestly, one of the most overlooked rules in all of investing. It's a concept that can feel like a bit of a secret, something the pros on Wall Street keep to themselves. But once you get it, it will fundamentally change how you look at every single investment you make from here on out. This quote, it just fits perfectly because the world of investing, a lot like Fight Club, has its own set of unbreakable rules. And the one we're going to break down today, it's the first, and I think the most important rule for building a portfolio that can actually stand up to whatever the market throws at it. So here's the game plan. First, we're going to lay out the rule itself nice and clear. Then we'll nail down what a hedge actually is. After that, we'll look at the tools you need, explore a killer all-in-one strategy, and wrap up with a simple test to make sure your shield is actually working. Sound good? Let's jump in. Okay, right here. This is the heart of it all. If you only take away one thing from our time together today, make it this. This is the bedrock. Everything else we talk about is built on this foundation. And there it is. Simple, direct, and completely non-negotiable. Hedge every single investment. This means you never ever just buy something and cross your fingers, hoping for the best. For every position you take, you have to have a concrete plan, a safety net to protect yourself if things head south. It's all about building your defense directly into your offense, right from day one. So that leads to the big question, right? What in the world is a hedge? It's a word that gets thrown around all the time, and frankly, it can be pretty confusing. So let's just strip away all the jargon and get to a simple, powerful definition. Just think of a hedge as your financial safety net. It's basically an insurance policy on your investment. If your main bet starts to lose money, the hedge is designed to kick in, either slowing down the fall or, even better, putting a hard floor under it so it can't drop any further. It's all about taking back control and defining exactly how much you're willing to lose ahead of time. Okay, theory is one thing, but this is where the rubber meets the road. Let's make this real. Let's look at the actual profit and loss numbers for an investment, both before and after we put a proper hedge in place.
Ah, yes. This is the feeling most investors know all too well. You buy a stock and you are just on for the ride. You are completely exposed to every single move, up and down. For better or for worse, your fate is 100% tied to that squiggly line on the screen.
And look at this table. It's perfectly symmetrical. The stock goes up 20 bucks, you make 20 bucks. Fantastic. But if it drops 20 bucks, you lose 20. There is no safety net. Your downside is completely unlimited, all the way to zero. This is like riding the roller coaster without a seatbelt. All right, now this is where the magic happens. Let's introduce our hedge and just watch how it completely transforms the entire picture.
And this is the power of hedging, right here on one slide. Just look at those bottom two rows. It doesn't matter if the stock drops $10, $20, or even $50, our loss is capped. It cannot go below $5. We've built a floor. Now you do see there's a small cost, right? That $2 is the price of our insurance. We give up a tiny little piece of the upside to get absolute certainty and peace of mind on the downside. That trade-off, that is the whole game.
Okay, so the concept is clear, but how do you actually do this? What are the real-world tools? Well, the good news is it's not as complex as it might sound. There are 3 basic, really powerful tactics we can use, and they all revolve around a financial tool called options. These are your 3 core building blocks: the married put, the collar, and using something called in-the-money options. You can think of them like the primary colors. You can use them and combine them to create pretty much any kind of protection you need. Let's do a quick flyby of each one. So first up is the married put. This is the most direct, straightforward form of insurance there is. At the exact same time you buy a stock, you also buy a put option. And that option gives you the right to sell your stock at a guaranteed price, no matter how far it falls. That guaranteed price becomes your absolute floor. Simple as that. Next up, the collar. This is a really clever strategy to lower or sometimes even completely eliminate the cost of that insurance. So you still buy your protective put option, but to help pay for it, you also sell a call option. Selling that call just means you agree to sell your stock if the price goes above a certain level. The trade-off is really clear. You get your downside protection for a lot less money, but in exchange, you cap your potential profit on the upside. And finally, we've got in-the-money options. Now, this approach is a little different. Here, instead of buying the stock itself, you use a special type of option as a substitute for the stock. This gives you almost the same exposure to the stock's potential gains, but, and this is the key part, with a much smaller investment upfront and a clearly defined limited risk from the get-go. It's a way to control the stock without having to own it outright.
Now, let's be honest. Hedging every single stock in your portfolio one by one can take some time. So there is another really powerful approach, a way to create one single shield that protects your entire portfolio all at once.
The idea here is really simple. Instead of insuring every stock individually, you just buy one big insurance policy on the whole thing. It's a 3-step recipe. First, you calculate the total value you need to protect. Second, you find a broad market fund, like an S&P 500 ETF that basically moves in step with your portfolio. And third, you buy put options on that ETF. And boom, you've protected your entire basket of investments in one shot. So why would you do this? Well, for one, it's incredibly efficient. You're managing one single position instead of 10 or 20. But really, the strategy is all about protecting yourself from what they call systemic risk. You know, those huge, terrifying market crashes that just seem to drag everything down with them. With a portfolio hedge, you're basically saying, look, I can live with 1 or 2 of my stocks going down, but I absolutely need protection if the entire market decides to fall off a cliff. All right, we're in the home stretch, our final section. And this is so important. You've set up your hedge, but how do you know it's actually working? How can you measure if it's effective? Well, there's a simple little number for that. It's called delta, and it is the perfect litmus test. The easiest way to think of delta is as a sensitivity gauge. See, a normal stock all by itself has a delta of +1. That just means for every $1 the stock moves, your investment value moves by $1. A good hedge is designed to lower that number, to reduce your sensitivity and slow everything down. Let's make this totally concrete. Imagine your combined position, your stock plus its hedge, has a total delta of 0.7. What does that actually mean?
It means for every $1 the stock price moves, your total investment value is now only going to move by 70 cents. See that? You've successfully dampened the volatility. You've slowed down the ride.
So here's the bottom line. This simple rule of thumb: a successfully hedged position will always have a delta between 0 and 1. A delta of 1 is totally unhedged, a delta of 0.5 is nicely hedged, and a delta of, say, 0.2 is very, very heavily hedged. The closer that number gets to 0, the more protection you have in place. It's your simple, at-a-glance check to know your shield is up.
And that's it. That's the first iron rule. Hedge every investment. It completely transforms investing from a game of just trying to pick winners to a strategy of building a resilient system, a system that protects you, especially when you're wrong. So the question I want to leave you with is this: what in your portfolio right now is flying without a safety net? And how might applying this one simple rule change your entire approach to the market?
Hey everyone, welcome. If you're like most investors, you probably measure your success with just one single number: your return. But what if I told you that's kind of like a golfer measuring their success by how tall they are? It's an amateur move. Today, we're going to dive into how the pros really think by focusing on the one thing that truly separates them from the crowd: their mastery of risk.
I mean, you gotta love this classic line from Caddyshack, right? It perfectly nails how most people approach investing. We get so focused on a simple metric: are we up or are we down? But that's exactly like judging a golfer by their height. Sure, it gives you a number, but it tells you absolutely nothing about their actual performance. Well, that all changes today.
So what's the solution? It comes from what the source material calls Iron Rule number 2: know your risk metrics. And listen, this isn't just a friendly suggestion. This is the key. This is what helps you move from being a casual investor to someone who manages their portfolio with real professional discipline. It's all about finally adding that crucial context to your returns.
Okay, so here's our game plan. First, we're going to introduce the 4 T metrics for measuring what really matters. Then, we'll dig into each one, what I like to call your portfolio's sleep number. We'll get into the real truth about volatility and leverage, and we'll uncover the hidden role of correlation. And then, at the end, we'll see how it all comes together to give you the complete picture.
Risk can feel like this big, vague, abstract concept. It's kind of like the monster under the bed. But you know what? We can turn on the lights. We can make risk concrete, tangible, and most importantly, manageable, just by breaking it down into 4 specific, measurable parts.
And here they are. These are the 4 horsemen of risk management, but trust me, they're here to help you, not haunt you. We've got capital at risk, volatility, implied leverage, and correlation. Together, they form the foundation of a really sophisticated risk framework that honestly, anyone can use. So let's tackle them one by one.
We're going to start with a custom-made but incredibly intuitive metric called capital at risk, or CARE for short. Let's forget about complex formulas for just a second. This is all about answering one simple but really powerful question: what is my absolute worst-case scenario?
So here's the formal definition. It's the total loss you would face if an investment went as wrong as it could possibly go, after you account for any protection or hedges you've put in place. It's basically your financial doomsday number. Let's make this real. Okay, look on the left. An unhedged investment. You buy 10 grand of stock, your worst case scenario is losing the entire 10 grand. Pretty simple. But now check out what happens on the right when you add some protection. You spend $500 on a hedge that kicks in after a 10% drop. Now your maximum loss on the stock is capped at $1,000. So your total capital at risk becomes that $1,000 loss plus the $500 cost of the hedge, just $1,500. You've just defined and dramatically shrunk your worst case scenario. The source material has this brilliant analogy for this. Think of your portfolio's total capital at risk as its sleep number. It's the maximum amount of money you could possibly lose in a total market catastrophe. So I'll ask you, what's the number that would still let you sleep comfortably at night? That's your portfolio's sleep number. All right, let's move on to our second metric, volatility. Now, this is the one you hear about all the time on financial news. It's Wall Street's favorite way to measure risk, and it's absolutely crucial for understanding the potential roller coaster ride of your investments. At its core, volatility just measures how much an investment's price swings around. A high volatility stock is like a speedboat in a storm. Sure, it can make huge moves up, but it can also make huge moves down. A low volatility investment is more like a cruise ship.
The wider that potential range of outcomes, the riskier the investment is considered to be. Okay, now calculating this might sound a little intimidating, but the concept is actually pretty simple. It's a 4-step process, and any spreadsheet program can handle it for you. You're basically just looking at how much your portfolio's value changes each day over a year, and then you're calculating the standard deviation. Think of it as the average wobble of those changes. That last step just annualizes the number. Look, the point isn't the math. It's getting a single comparable figure that tells you just how bumpy your ride is compared to the rest of the market.
The word leverage, yeah, it has a bit of a bad reputation, and honestly, for good reason. It was a key villain back in the 2008 financial crisis. But when we talk about leverage here, we're not just talking about borrowing money from your broker. We're looking at a more subtle and frankly more powerful form called implied leverage.
So what is implied leverage? It measures the total firepower of your portfolio. See, when you use things like options, you can control a very large amount of stock with a relatively small amount of capital. This metric captures that power. It tells you the total value of the market you're actually exposed to, not just the cash value of your account.
Let's look at the upside, because this is what gets people excited. We have two identical $100,000 portfolios. Portfolio 1 has an implied leverage of 1.0, but Portfolio 2 uses options to push its implied leverage up to 1.5. When the market goes up 10%, that extra leverage means Portfolio 2 makes almost 50% more money. I mean, that's the seductive power of leverage, right?
But, and this is a huge but, leverage is a double-edged sword. When the market drops 10%, that exact same amplifying effect works in reverse. Now, Portfolio 2 loses significantly more than Portfolio 1. And this is the danger. If you don't track your implied leverage, you can get seriously hurt without even realizing you were taking on that much risk in the first place.
So what's the big takeaway here? What's the rule? It's simple and it's non-negotiable. Keep your implied leverage at 1.0 or lower. All that means is the total market value you control should not exceed the actual value of your portfolio. No excess leverage, period. Okay, our final metric is something called correlation. And a great way to think of your investments is like a family. Some are really close relatives, like siblings, and they tend to act alike. Others are more like distant cousins. Well, correlation is the metric that measures this closeness, and it reveals the hidden relationships between all your assets.
So correlation measures how two investments move in relation to each other on a scale from -1 to +1. A +1 means they move in perfect lockstep. A -1 means when one zigs, the other zags. And 0 just means there's no predictable relationship at all. So for example, United and Delta Airlines stocks. They're similar businesses, so it's no surprise they have a high positive correlation. They tend to move up and down together.
So how do you actually use this? Well, it's all about building true diversification. First, you need to understand how your existing investments relate to each other. Are they all tech stocks that pretty much move together? Second, before you add anything new, check its correlation to what you already own. Are you actually adding diversification, or are you just buying more of the same? And third, you need to know how each of your positions correlates with the market as a whole. Because if everything you own just moves with the S&P 500, you're not nearly as diversified as you think you are.
We have covered a lot of ground, but here is maybe the single most important lesson of this entire explainer. None of these metrics can be used in isolation. Their real power, their ability to completely transform your investing, comes from using them together as a complete system, like a dashboard for your portfolio's risk.
I want you to think of it this way. Capital at risk tells you your absolute worst-case loss. Volatility tells you how bumpy the ride might get. Implied leverage tells you how fast you're going, both uphill and downhill. And correlation, well, that tells you if all your passengers are trying to run to the same side of the boat at the exact same time.
And this is where it all connects. When you understand these metrics, you just make smarter decisions. Just like the source material says, if your correlation is high, you know your diversification is low. And that tells you that you need more conservative hedges to manage your capital at risk. You see that? You see how each dial on the dashboard informs all the others?
You know, we started with a joke from Caddyshack, but this question is dead serious. For far too long, investors have been measuring themselves by height. But now you have the tools to do it right. So the only question left is, are you going to keep measuring your portfolio by returns alone, or are you ready to step up and truly keep score?
All right, today we're going to dig into something that's, well, it's at the core of successful investing. How do you actually build a portfolio that's designed to last, not just for next quarter, but for the long haul?
we're going to break down the principles for putting together a long-term diversified portfolio using the buy and hedge strategy as our framework. So let's get into it. I know what you're thinking. Ace Ventura? Really? But stick with me here, because this silly quote actually gets at one of the most powerful and honestly, one of the hardest ideas in investing: patience. A great portfolio is built to win over years, not minutes. So the very first thing we have to get our heads around is that we need to give our strategy time to actually do its job. So here's our game plan for today. We're going to start with the dangers of thinking short term, then we'll flip that and see how to make time your best friend. After that, we'll demystify diversification with a pretty simple story. From there, we'll look at the modern tools that make this all possible, lay out a literal blueprint for your portfolio, and wrap up with one critical rule that you just cannot ignore. Okay, so let's start by defining the enemy. For most investors, the biggest threat isn't a stock market crash, it's their own impatience. This short-term thinking, it's what drives active traders, and it's a mindset that's just loaded with hidden costs and, frankly, self-destructive habits.
Now, what I love about this slide is just how stark the contrast is. On the left, you've got the world of a short-term trader. You're constantly trading, so you're racking up higher fees, you're watching the screen all day, which leads to emotional, knee-jerk decisions, and man, is it time-consuming. But look at the right side, the long-term approach. It's just calmer. It demands less of your time, and here's the kicker: it actually performs better. A big part of that is hedging, which means protecting your investments from those big gut punch downturns. We'll see later how vital that is. It's really about letting a protected strategy work for you instead of you constantly working against yourself.
So how do we fight back against this impatience? Well, you make patience itself a core part of your strategy. This isn't just about sitting on your hands and waiting. It's about deliberately building a portfolio with a long time horizon from day one. It's a huge mindset shift, right? It's moving from what's the market doing right now to where's this investment going to be in 5 years? Okay, let's make this really practical with a few hard and fast rules. First, start thinking in years, not months. Any new investment you make, you should plan to hold it for more than a year, period. Second, let your investments grow some roots. Your portfolio should always have some core positions that you've held for 2 years or more. And that last one, that's a hard stop. Never, ever invest with the idea that you're going to sell in under 6 months. It all boils down to this: if you don't have the confidence to hold something for the long haul, that's your sign. Don't buy it in the first place.
Now let's talk about this second pillar of a really solid portfolio: diversification. I know, it can sound like this really complex, jargony term, but it's not. It's actually a super simple, intuitive idea. And to get our heads around it, we're going to forget about stocks for a minute and just tell a little story. Just picture it. You're living the dream. You've got a little house on the water in some beautiful, remote part of Hawaii. Life is perfect. But there's a catch. Literally. If you want to eat that delicious fresh fish dinner every night, you've got to go out and catch it yourself every single day. All right, so day one, you go out and you cast a single fishing line into the water. Your entire dinner tonight hangs on that one line. The risk of you going hungry is pretty high, isn't it? The fish might not bite, the line could snap, a million things could go wrong. So you get smarter. You add a second line. Boom, you've just doubled your chances. But then you get even smarter. On a third line, you use a totally different kind of bait to attract a different kind of fish. And you know what? Just to be safe, you also drop a crab trap. Now, look what you've done. Any one of those lines could still fail, sure, but the odds of you going hungry tonight, they're now dramatically lower. You've successfully diversified how you get your food. And this is where the story stops being a story and becomes painfully real. Putting all your money into a single stock is exactly like casting that one single fishing line. And if that one stock happens to be, say, Enron back in 2001, well, you don't just go hungry for one night. Your entire retirement portfolio goes to zero. That is the kind of catastrophic risk that diversification is built to prevent. So if you need dozens of these fishing lines to be safe, how in the world do you manage it all? In the old days, getting truly diversified meant buying 30, 40, maybe 50 individual stocks. It was a logistical nightmare for the average person. But thankfully, modern finance came up with a really elegant solution for this exact problem. And that tool is the Exchange Traded Fund, or ETF. The easiest way to think about an ETF is like a pre-made basket of investments. You can buy or sell that entire basket with a single click, just like you would a single stock. But inside that basket, you might have hundreds or even thousands of different companies. So a single broad market ETF gives you instant diversification. It's that simple.
And that right there is the key insight, the massive leap in efficiency. Instead of the headache of trying to research and track dozens and dozens of individual companies, you can get incredible diversification just by buying a handful of ETFs. It gives you that broad market exposure, but with stunning simplicity. It's a total game changer for individual investors, no question.
Okay, so we get the principles, right? Think long-term and use ETFs to diversify. Now, for the really practical part. How do we actually put all the pieces together? Let's look at the blueprint for how to allocate your assets.
This is your starting point. This is the core buy and hedge portfolio. As you can see, the foundation, the vast majority, is a 70% chunk in broad market index ETFs, things that track the S&P 500 or the total stock market. Then we keep 10% in cash. That's for emergencies, sure, but also to jump on new opportunities. And that leaves us with the last 20%, which we call inner guru investments.
Now, this inner guru slice, this is where you get to test your own ideas. It's your space for picking those individual stocks you believe in, or maybe some sector ETFs you think are going to take off. And the best part is, it's flexible. If you don't want to pick stocks at all, no problem. You can take this down to zero and just be a pure index investor. Or, if you're feeling more confident, you can crank it up to as high as 40%. It lets you tailor the whole strategy to your own personal style. Now, let's watch how this blueprint evolves as your goals get closer. Let's say you're 10 years away from retirement. We start to shift our focus a little bit, away from pure growth and more towards generating income. We do this by introducing a 10% slice for bond ETFs. Now, in this strategy, bonds aren't really for reducing risk. We use hedging for that. Bonds are here specifically to start building a stable, predictable stream of income for your future. Okay, fast forward. Now you're just 5 years away from retirement, and you can see that shift gets more aggressive. We've bumped the bond allocation all the way up to 25%. And to pay for that, we've trimmed a little bit from both our broad market indexes and our inner guru picks. The logic is simple. We are systematically moving away from a pure growth focus and building up our income engine more and more. And finally, here we are 5 years into retirement. The portfolio has reached its mature long-term state. Bonds now make up a full 50% of the portfolio, and that is creating a really substantial, reliable income stream for you to live on. But, and this is critical, we still have 40% in growth-oriented assets. This makes sure your portfolio can keep growing and beat inflation, even while that big bond allocation provides all that stability. We have covered a ton of ground, from the right mindset all the way to a detailed blueprint. But I have to tell you, none of it, absolutely none of it, works without this final non-negotiable rule. The entire foundation of everything we just talked about rests on this one single principle. You have to follow it. You know what? I'm just going to read this directly from the slide because it is that important. Warning, if you do not hedge every position, this allocation recommendation adds substantial risk and has a good chance of not working. The reason these portfolios might look different from what you've seen before is because they assume hedging is handling your downside risk. If you take that protection away, a portfolio this heavy in stocks is taking on way more risk than it was ever designed for. Hedging is not optional in this system. It is the bedrock.
So let's just do a quick recap of the most important points. First, think long-term. Aim to hold your investments for more than a year. Second, use ETFs. They are your best friend for easy, effective diversification. Third, think of bonds as an income tool for when you're getting closer to your goal, not as your main way of managing risk. And finally, and I can't say this enough, remember that these blueprints are designed specifically for a portfolio where every single position is hedged.
So as we wrap this up, I just want to leave you with one simple question to think about. Take a hard look at your own strategy, your own habits, what's in your own portfolio. Is it built to win a sprint, chasing short-term fads, reacting to every news headline? Or is it built with patience and structure, designed to complete the long, rewarding marathon of investing? The answer to that question will tell you everything you need to know. Thanks for your time.
All right, let's get right into it. Today, we are talking about what it takes to go from just another do-it-yourself investor to a true champion of your own portfolio. This isn't just about playing in the market. It's about developing a mindset that helps you understand your own unique strengths and build a strategy that actually works for you.
You know, I love this quote. It might be from a comedy, but honestly, for us investors, the message is dead serious. It's about total commitment. If you're going to manage your own money, you have to be all in. You've got to step up and play to win. Because the alternative? Well, it's not pretty. And this is that alternative. Roughly a quarter, 1 in 4, of all do-it-yourself investors eventually just wash out. Their portfolios do so poorly, they're forced to give up. So all that bravado of playing like a champion runs headfirst into the very real risk of striking out completely. The stakes, they couldn't be higher. So, how do we make sure you're not one of those statistics? We follow a clear game plan. First, we're going to talk about what it really means to find your inner guru. Then, we'll tackle the 2 biggest challenges every single investor faces: finding your edge and taming overconfidence. After that, we'll lay out a practical game plan in your next move. Okay, this right here is the absolute core of our entire explainer. The real secret to consistent success in investing isn't some magic formula you're going to find online. Nope, it's about finding and, unleashing the expert that already exists inside of you. It's time to meet your inner guru. Now let's be super clear about what inner guru means. This isn't about some kind of mystical nonsense. It's about doing the work. It's about rigorous, brutally honest self-analysis to find out what your unique specialty really is. A guru investor knows their strength because they've put in the time to uncover them. And that self-awareness, it creates focus. And that focus, well, that's power. And when you put these 2 side by side, the difference is it's stark, isn't it? The average investor is all over the place, chasing hot trends, making decisions based on fear or greed. The guru, they're the complete opposite. They're focused on what they know works for them, they're incredibly disciplined, and their analysis is proactive, not reactive. So which column do you want to be in? Of course, if this were easy, everybody would be a guru investor, right? The path to unleashing that inner expert is actually blocked by 2 major hurdles that trip up almost everybody. So let's break them down one by one. Here is the first huge challenge. How do you really know what your strengths are? I mean, in a market this complex, was that last winning trade a result of your skill, or was it just dumb luck? So many investors get a few wins, feel like geniuses, but then their losses completely wipe out those gains. And it's because they never figured out what their repeatable edge actually was. So how do you separate the skill from the luck? Well, the solution is surprisingly simple, but it's incredibly powerful. You have to keep a detailed investment journal. I want you to think of it like a professional athlete watching game tape. It's the only way to do an honest self-analysis, to see the game clearly, and to find the real patterns in your own performance. And this is exactly how it works. For every single trade, you write down your rationale, the why. Why are you doing this? You set a clear target price and how long you plan to hold it. And this is crucial. You take a second to note your emotional state. Are you feeling greedy, scared? Then you log the actual results. So maybe 6 months from now, you look back at your journal and you have this aha moment. You realize every single big win you had was in small cap biotech stocks you bought right after a major conference, and you held them for less than 90 days. That's an edge. And at the same time, that journal shows you that every time you tried to buy a struggling retail company, you lost money. This process turns your gut feelings into cold, hard data. It shows you what you're really good at. Okay, let's move on to our second challenge, and this one's a little ironic. See, this problem doesn't come from failure. It actually comes from success. Once you've used your journal and you've actually found your edge, a new, much more subtle danger creeps in: overconfidence. Here's exactly how it happens. You discover you've got a real knack for picking winning healthcare stocks. It feels great. You feel like a genius. So what do? You start putting more and more of your money into that one sector. And before you know it, your entire portfolio has this massive, dangerous flaw. You are over-concentrated. You've put way too many eggs in one basket. And this is what that danger looks like on paper. Imagine this investor is an absolute wizard at picking tech stocks. You know what? It doesn't matter. If the entire tech sector takes a nosedive because of new regulations or some supply chain crisis, their whole portfolio gets crushed. Even the best companies in the world go down when their whole sector sinks. This kind of concentration is just a recipe for disaster. So, we need some defensive rules to protect us from our own success. And the solution is 2 simple, completely non-negotiable guardrails. First, no single stock sector ever goes above 10% of your total portfolio. Ever. And second, at least half of your portfolio, 50%, must be in broad market indexes. These are not suggestions. These are the rules that keep you safe, no matter how confident you're feeling. So, we figured out the goal: becoming that inner guru. And we've tackled the two main challenges that stand in our way. Now, let's put all of these pieces together into one single, coherent strategy. This is the guru's game plan for building a powerful but also resilient portfolio. Here it is laid out plain and simple. Your foundation, a minimum of 50%, is in broad market indexes. This is your stability, this is your bedrock. The next slice, that chunk between 10% and 40%, that's where you get to unleash your inner guru. This is for your individual ideas based on your proven strengths. And within that, you always respect that hard ceiling, a maximum of 10% in any one sector. And here's what that looks like in practice: a really healthy, well-structured portfolio. You've got that big 50% core in indexes. Then maybe you dedicate 30% to your individual guru picks, spread across different areas you know well. Maybe you make one specific concentrated bet on a sector, but you keep it at that 10% limit. And you always have some cash on the side. It's focused, but it's diversified. It's powerful, but it's safe. And all of this brings us back to the most important rule of all, the one that underpins this entire strategy. Rule number 1, always hedge. In this game plan, those broad market indexes are your hedge. They provide that stable foundation that protects your downside. And it's only because that hedge is in place that you can confidently go out and make those individual guru investments. That protection takes away the fear of catastrophic loss, and it frees you up to trust your analysis and, yes, play like a champion. Okay, we've covered the what and the why. Now it's time for the how. Let's shift our focus from just learning this stuff to actually putting it into practice. This is your next move to become the champion of your portfolio. Here it is, your champion checklist. Number 1, unleash that inner guru by trusting your own analysis. 2, start keeping that detailed investment journal today, not tomorrow, today. 3, focus your individual stock picks on your proven strengths. 4, never, ever forget to hedge. And 5, stick to those 50-40-10 allocation rules. That is your path forward. So I'll just leave you with this final thought. The expert you're looking for, they're not on TV, they're not in some fancy newsletter. They are already inside your head, whispering what you're good at based on your own unique life experience. The only question is, are you taking the notes? Are you keeping the journal you need to actually hear what your inner guru has been trying to tell you? You know the feeling, right? Should I sell now and lock in this profit, or should I let it ride? It's a question that literally every investor wrestles with. Well, today, we're going to tackle it head-on by digging into a really crucial skill, knowing exactly when and how to harvest your gains, and, just as importantly, your losses. Always be closing. You've probably heard this one before. It's that legendary, high-octane mantra from the world of sales. But what if, and hear me out on this, what if we took that same relentless focus, that same drive to close the deal, and applied it directly to our investment portfolios? Well, that's pretty much what we're talking about today. The word for it is harvesting. And it's not just a fancy term. Just like a farmer who knows the perfect moment to gather a crop, a smart investor knows when to close a position and lock in the result, whether that's a big win or a strategic loss. It's all about taking deliberate, decisive action. So let's just shift our whole mindset for a minute. Forget that frantic salesman energy. Instead, I want you to embrace the patient, methodical wisdom of a farmer. You plant your seeds. Those are your investments. You tend to them, you watch them grow. But a great farmer knows the job isn't over yet. The real skill is knowing the exact right moment to bring in that crop. So here's what we're going to cover. First, we'll talk about knowing when your original plan has just run its course. Then we'll get into what to do when you get a massive, sudden windfall. After that, we'll dig into how to use harvesting for tax season. And finally, we'll pull it all together so you can become a truly smart harvester. All right, let's jump in. First up, let's cover the most fundamental reason to harvest anything. Your plan worked. Or it didn't. Either way, it played out. This is all about pure discipline, taking emotion completely out of the equation and just sticking to the strategy you had from day one. It really boils down to two incredibly simple black and white triggers. On one hand, the plan succeeds. Your investment hits that price target you set for it. Awesome. You sell. On the other hand, the plan fails. The whole reason you bought the investment in the first place is no longer true. You sell. See? In either case, the decision is already made for you. The season's over. Look, this is not about gut feelings or what you read in the headlines that morning. It's a system. You should be doing this, say, once a month. Just a simple check-in. Ask yourself 2 questions. Number 1, Does my original thesis still hold up? And number 2, has the price hit my target, either on the upside or the downside? If you get a yes to either of those, you move to step 3. You take action. You close the position. That's what discipline looks like in the real world. Okay, so that's the basics. Pretty straightforward. But what about a scenario that's a lot trickier? And let's be honest, a lot more exciting. What do you do when you hit a bumper crop? A huge, fast gain, but you're absolutely convinced there's still more upside to come. Let's get into it.
I mean, come on, this is the classic investor's dilemma. We've all been there. You're sitting on this massive pile of paper profits. The greedy voice in your head is screaming, let it ride, to the moon. But that quiet, fearful voice is whispering, don't be a fool, you could lose it all tomorrow. So what's the right move?
Well, the smart move requires you to understand 2 key numbers, especially if you're using a hedge strategy where you've got some downside protection. The first one is your unrealized gain. That's just your on-paper profit. The second is something called capital at risk, or KR. Think of that as your absolute worst-case scenario number. The relationship between these two? Well, that's the secret sauce.
Let's make this real. So you put on a new hedge trade. On day 1, your unrealized gain is 0. You haven't made a dime yet. But your capital at risk, that's the $10,000 you have on the line, right now it's all risk and no reward.
But then, boom, the investment just takes off. Suddenly, your unrealized gain has shot up to $10,000. Now, here is the rule of thumb you got to remember. Your paper profit is now more than 50% of your total capital at risk. That is your trigger point. Why? Because the whole game has changed. You now have a massive profit to protect. The alarm bell is ringing, telling you it's time to take some of those chips off the table before a storm hits.
And this is so important. It doesn't mean you have to sell the whole thing and walk away. No way. The goal here is to be strategic. You're basically taking some of that profit, turning it from paper into real cash, while leaving the rest of the investment in place to keep growing. And look at the result. It's beautiful. You've harvested that $10,000 gain. It's not paper money anymore. It's real cash safe in your account. And just look at what happened to your risk. Your new capital at risk has been slashed down to $6,000. You've protected your windfall, you've lowered your exposure, and you're still in the game. Now that is a professional move.
Okay, let's shift gears. We've talked about managing winners and losers during the year, but harvesting is also an incredibly powerful tool for your year-end financial cleanup, especially when it comes to everybody's favorite subject, taxes. And it all starts with one magic number that you need to burn into your memory, $3,000. The IRS lets you deduct up to $3,000 in net capital losses from your regular income every year. This directly lowers your tax bill, and understanding how to use this rule is the key to smart tax loss harvesting. So here are 3 common situations you might find yourself in as the year winds down. First up, offset gains. Let's say you've cashed in some winners, but you also have some investments that are underwater. Well, you can sell those losers to realize the loss, which then cancels out some of your gains, lowering your tax bill. The second scenario is the reverse. You actually have more than $3,000 in losses. You can sell some winners to use up those extra losses now so they don't just carry over. And finally, push gains. If you have a huge winner late in December, you might just hold on to it until January. Why? To push that tax event into the next year. But, and this is a big but, you got to be careful. The IRS is not stupid. They have this little thing called the wash sale rule. You can't just sell a stock on Monday to get the tax break and then buy it right back on Tuesday. If you do that, they'll disallow the loss. To do it by the book, you have to wait at least 30 days before you repurchase that same investment. So play it smart. All right, let's pull all this together. We've covered a lot of ground. So what does it really mean to be a smart, strategic harvester of your own financial field? What are the big lessons here? Here's what you need to remember. First, get comfortable with selling. High portfolio turnover isn't a sign of failure. It's a sign that you have a healthy, active system with clear rules. Second, learn how to use tools like hedging. They're an amazing way to lock in profits without having to bail on a great investment entirely. Third, be proactive about your taxes. It's one of the only things in investing you can actually control. And finally, remember that all of this comes down to having a smart, logical process, not just making emotional, gut-level decisions. You know, this really brings us right back to our farming metaphor.
A farmer understands that you have to clear out the waste, the failed crop, to make room for the next planting season. Your portfolio is the exact same way. Cutting a losing investment isn't just about stopping the bleeding. It's about freeing up your money and, frankly, your mental energy for the next great opportunity.
So I'm going to leave you with this one question. Take a good, hard look at your own portfolio. What do you see? Is it a well-tended farm, managed with real discipline and a clear plan for every season? Or is it just a messy field left to the whims of the market? The choice to become a smart harvester, well, that's up to you. Thanks for watching.
You know, when we talk about investing, it feels like it's always about offense, right? Finding that next big thing, cranking up our returns. But what about defense? What about protecting what you've already got? Okay, let's dive into this, because it's the side of investing that's often overlooked, but it is absolutely critical. We're talking about how to protect what you've worked so hard to build.
You gotta love this line from the movie The Bodyguard. It just perfectly sums up what real protection is all about. Look, you can't stop bad things from happening out there in the world, but you can be damn sure it doesn't happen on your watch to what you're responsible for.
And that, right there, is the exact mindset we need for our portfolios. You can't stop the market from having a bad day or a bad month, but you can put things in place to make sure your portfolio isn't the one getting carried out on a stretcher. You need a financial bodyguard. So, what are we actually protecting it from? Well, the main enemy, the big threat that we're building all these defenses against, is volatility. It's those wild, unpredictable swings in the market that can just destroy even the best-laid plans. And to really get why, let me ask you something.
Just take a look at these two potential paths. For a second, just forget about where they end up. Just think about the ride, the journey itself. Which one of these looks more, manageable? Which one would you rather live through as an investor?
Let's call this the investor taste test. You've got portfolio A with its nice, steady gains and, yeah, some modest losses. Then you have portfolio B. Sure, it's got those thrilling highs, but it also comes with those gut-wrenching, keep-you-up-at-night drops. And what's really fascinating here is that our gut feeling is totally backed up by hard math. The power of compounding shows that avoiding those huge losses is way more important than catching every massive gain. Think about it. A 50% loss means you need a 100% gain just to get back to where you started. That is a brutal, brutal climb. The main point is we have to tame that volatility.
And that's where our bodyguard comes in. It's called a hedge. A hedge is a purely defensive move. It's an investment you make specifically to cut down or even totally cancel out your losses if the market takes a nosedive. It's your portfolio's own personal Secret Service agent.
Now, the absolute gold standard here is what we call an absolute hedge. And I want to be clear, this is not just a simple stop-loss order that just sells you out of a position. No. This is way more sophisticated. An absolute hedge is a counterbalance. It's a totally separate position that actually starts going up in value at the exact same time your main investment is going down. It effectively puts a hard, solid floor under your losses.
And this is just a brilliant way to picture how it works. You know those little Chinese finger cuff toys? You stick your fingers in, and the second you try to pull away, the cuff just tightens. The harder you pull, the tighter it grips you. A really effective hedge works exactly like that. The worse things get for your main investment, the harder the market pulls against you, the stronger your hedge kicks in to save the day.
So, how do we actually build one of these things? Well, you might hear about general market hedges, like buying an oil stock because you're worried about gas prices going up. It kind of makes sense, but honestly, the connection is usually pretty loose. It's not exact. But then you've got correlated option hedges. Now, this is a whole different ballgame. This approach is mathematically precise. It's predictable. It's designed to directly protect the exact stock or asset you're worried about.
And that's our cue to bring in the ultimate tool in our defensive playbook, options. I mean, when it comes to creating these precise, powerful, totally predictable hedges, options are simply in a league of their own.
So, what makes them so special? Why are they the perfect instrument for the job of protecting your portfolio? Well, it really boils down to three huge core strengths.
Okay, first up, and you could argue this is the most important one of all, is the unbelievable level of control they give you. We're talking about certainty and precision. Look, here's the key thing to get. You cannot control what the market's going to do. Nobody can. But with options, you can control your risk. You can use them to define, with almost perfect mathematical certainty, the exact range of outcomes for your investment. You get to decide, right up front, this is exactly how much I'm willing to lose, and not a penny more.
All right, the second major advantage is all about efficiency. It's about getting the most protective bang for your buck.
Options give you this amazing thing called leverage. Now, what that really means is you can control a huge chunk of stock, let's say the equivalent of 100 shares, without actually having to fork over all the cash to buy those 100 shares. You can build a really powerful defensive wall around your portfolio for just a fraction of the cost. It's incredibly smart with your capital.
I mean, think about it like this, right? To insure your house against a fire, you don't have to give the insurance company the full value of the house in cash. That would be insane. You just pay a small premium for that protection. Well, options work the exact same way for your portfolio. They let you buy incredibly effective protection for a much, much smaller price tag.
And that leads us to the third advantage. And honestly, this might be the most elegant and powerful part of using options for hedging, which is how you actually pay for it.
Believe it or not, options can actually pay for themselves. This is a total game changer. So imagine you own a stock that's at $100. You want to protect it, but you don't want to pay anything out of pocket. Well, using a smart combination of options, you can sell what's called a call option. That's basically an agreement to sell your stock if it goes up past a certain price, say $110. Now you get paid cash, a premium, for making that deal. Then you take that cash you just made and use it to buy a put option, which gives you the right to sell your stock if it falls below $90. You've essentially created a self-funding insurance policy for your stock, paid for by selling off a little bit of your potential far in the future gains. It's brilliant.
All right, let's bring it all home. Let's put this together into a clear, simple playbook. What are the key lessons you need to take away from all this for your own investment strategy?
So let's run through the playbook one last time. First off, when you need powerful, precise defense for your portfolio, options should be your go-to tool. Second, they are unique in their ability to let you define your absolute floor, your maximum risk, with incredible certainty. Third, they do all of this with amazing capital efficiency, all thanks to leverage. And finally, the real masterstroke. They have this built-in engine that can generate income to actually pay for the protection itself. It's a complete, elegant system for defense.
So I'm going to leave you with this thought. We spend so much time and energy trying to predict the unpredictable, trying to guess what the market's going to do next. But what if we just shifted our focus? What if instead of chasing returns, we focused on the one thing we can actually control, our risk? Because with the right tools, you can manage that risk with a level of certainty that can fundamentally change the way you invest, forever.
All right, let's talk about a subject that, let's be honest, can sound pretty intimidating to a lot of people: financial options. You probably heard the term, maybe seen it pop up in your brokerage account, but what are they, really? And, why should you even care? Well, it's because they can be an incredible tool for protecting your investments or for controlling a huge position with just a little bit of capital. So let's break it all down.
I mean, what a line, right? Absolutely iconic. For Gene Kranz and the crew of Apollo 13, failure just wasn't a choice. It wasn't on the menu. But in finance, the word option means the exact opposite. It's not about a lack of choice. It is literally all about having a choice.
When most people hear options trading, their minds immediately jump to high-stakes, all-or-nothing gambling. And look, can they be used that way? Absolutely. But that is not even half the story. The truth is, options were originally invented to be one of the best tools out there for protecting your portfolio, for putting a hard limit on your potential risk.
So here's our game plan for this explainer. First, we're going to flip the script on what options are all about. Then, we'll use some everyday examples, pizza and dishwashers, believe it or not, to make it all click. After that, we'll decode the contract itself, get clear on puts versus calls, talk about price and time, and finally, learn how to read an option ticker like you've been doing it for years.
Okay, let's dive right in. Section 1. Failure is an option. We're going to start by really challenging that idea of options being just some kind of speculative dynamite, and instead see them for what they really are: a powerful form of financial insurance.
And this is not some tiny, obscure corner of the financial world. We are talking about massive scale here. On an average day, we're looking at nearly 14 million option contracts changing hands. This isn't just for some Wall Street geniuses. It's a totally mainstream tool that countless investors use to manage their money every single day.
All right, before we get completely lost in a sea of financial jargon, let's just build some intuition. Because the basic ideas behind options, well, they're things you probably run into all the time. So let's talk about two things you definitely wouldn't expect: pizza and dishwashers.
Okay, just think about a pizza coupon. Let's say you've got one that lets you buy a large pizza for $10 anytime in the next month. Now, if the pizzeria jacks up their price to $15, suddenly that coupon in your wallet is pretty valuable, right? You have the right to buy that pizza for $10, but you're not forced to. If you decide you want tacos instead, you just toss the coupon. That's it. That right there is a call option.
Now, what about a warranty? You buy a new dishwasher, you pay a little extra for that piece of paper. If the dishwasher runs perfectly for 10 years, well, you just bought peace of mind. But what if it completely breaks down? Suddenly, that warranty is incredibly valuable. It gives you the right to basically sell your broken machine back to the store for a working one. This is the whole idea behind a put option. It becomes valuable when the value of something else goes down.
So those analogies really give us the spirit of the whole thing. Now let's get a little more precise and actually decode what an option contract is. We're going to break it down into 4 key parts. Okay, here it is, the full formal definition. I know it looks a little dense, but trust me, every single word in there matters. We're going to use this exact sentence as our roadmap for the next few minutes and just pull it apart, piece by piece.
First things first, let's focus on that word contract. This isn't some casual handshake deal. It is a binding agreement. The terms, the price, the date, they are all set in stone. But here's the really cool part. It's a tradable contract. You don't have to be the one to see it through to the end. You can sell the contract itself to another investor anytime you want before it expires.
Okay, on to the next part of our definition, the buy/sell action. Every single option in the world boils down to one of these 2 basic actions, and that brings us to the most fundamental split in the options universe, puts versus calls. And this really simplifies things. If you buy a call option, you are fundamentally bullish. You believe the price of the thing you're betting on is going to go up. It's the pizza coupon. It only becomes valuable if the price of pizza goes up. On the flip side, if you buy a put option, you're bearish. You think the price is going to go down. That's the dishwasher warranty. It only pays off if things go wrong. Now, it is super easy to get these 2 mixed up when you're starting out, so here's a fantastic little trick to remember it. Just think of it like this. With a call option, you are calling the stock to you, like you're calling it into your account. You're buying it. With a put option, you are putting the stock away from you, getting rid of it. You're selling it. Call to you, put away from you. Simple. All right, our definition is really starting to take shape. We've got the contract part down and the buy-sell action. Now let's hit the next 2 really crucial pieces, the predetermined price and the predetermined time.
So that predetermined price, it has a special name, the strike price. This is the number that is literally written into the contract and it never ever changes. It doesn't matter if the stock is going crazy up or down in the market, the strike price is your anchor. It's the price at which you have the right to do business.
And this example just shows you perfectly how that strike price creates value. Let's imagine GE stock is trading for $20 a share. If you own a call option with a $15 strike, you are sitting pretty. You have the right to buy that $20 stock for only $15. Now let's flip it. Say you want a put option with a $30 strike. You're also in a great position. You have the right to sell that same $20 stock for $30. See how that works?
And now for the timepiece of the puzzle. This is maybe the single biggest difference between owning a stock and owning an option. A stock, can theoretically last forever, but an option has a ticking clock. It has a specific expiration date, and after that date passes, it becomes completely worthless. Poof! The contract is just void. Time is a resource that is always draining away when you own an option.
Now, the specific rules for expiration can get a little quirky, but here's the thing. You don't have to memorize them. Here's what you really need to know. All the different lifespans, weekly, monthly, you name it, they all boil down to one simple, critical number that your brokerage account will always show you, days until expiration. That is the only clock you really need to watch. So there we have it. We have broken down all 4 parts of that dense definition. So for our final step, let's put it all back together and see how these things are actually listed in the real world. Let's learn how to read the ticker.
So you might see something in your account that looks just like this, GE SEP11 20 call. It looks like code, right? But now we have the key to decipher it. GE is obviously the stock. SEP11 tells us the expiration, September of 2011. 20 is our strike price, $20. And call tells us what kind of action it is, the right to buy. So we can take that bit of code and translate it into a simple sentence.
This contract represents the right to buy 100 shares of General Electric stock at $20 a share anytime before it expires in September 2011. Oh, and that 100 shares part? That's pretty much always the case. One standard stock options contract almost always controls 100 shares.
And that's really it. We've decoded the whole thing. Every single option, I don't care how complicated it looks on the screen, is built from these same 4 parts. What's the asset? When does it end? What's the price? And is it the right to buy or to sell? If you can answer those 4 questions, you understand the contract.
So we know an option gives the buyer a choice, a right, but here's the other side of that coin. For every buyer, there's a seller who is taking on an obligation. And that leads us to the final, really critical question. How does the market decide what that choice is worth? The price you actually pay for an option is called the premium. So what goes into that? What things, like time or how jumpy the stock is, determine how much that choice costs? That's the next step, but it all starts with knowing exactly what you're buying.
All right, let's talk options. Have you ever looked at an option quote and thought it was written in some kind of secret code? Just a jumble of letters and numbers? Well, you are definitely not alone. Today, we're going to crack that code. We are diving headfirst into the world of option positions, and I promise, by the time we're done here, you'll be able to read one of these things like it's plain English. I keep my options open. It's a great line, right? And it gets right to the heart of what an option really is. It's about having a choice. Now, in the financial world, an option gives you the right to do something, and this is the key, not the obligation. You don't have to do it. And it's that flexibility, that choice, that makes options so powerful.
Okay, so here's our game plan. First, we're going to look at the 2 sides of every single options trade. Then we'll get practical and learn how to actually read an option position. After that, we'll take a tour of the option chain. That's the marketplace for all this stuff. Then we'll figure out what in, out, or at the money actually means. And finally, we'll wrap it all up with the key things you gotta remember. Let's do it. So first things first, you have to remember that every single option is a contract. It's not like buying a share of stock where you're just one of millions. No, a contract always needs 2 people. It's a real agreement, a handshake between a buyer and a seller on very specific terms. That's it. It's really that simple, a buyer and a seller. This 2-sided coin is the bedrock of the entire options market. You've got one person who wants to buy a choice and another person who's willing to sell them that choice. Their goals are totally different, and understanding that is absolutely crucial. So let's break down who holds the power here. On one side, you've got the buyer. We also call them the owner, or say they're long the option. They have all the power, all the rights. They pay a little bit of money, that's called the premium, for the privilege of choice. On the other side, you have the seller. We call them the writer, or say they're short. They have the obligation. See the difference? They get paid that premium up front, which is nice, but in return, they are on the hook. They must deliver if the buyer decides to use their right. So the buyer is paying for a shot at a big win, and the seller is collecting cash for taking on the other side of that bet. Okay, now for the fun part. Let's take what we just learned and apply it to reading one of those secret code option positions. It might look like gibberish at first, but I promise you, every single part has a very clear, very simple job to do. So here we go. This is what you might see on a trading screen. 5 GE SEP 1120 calls. Looks like a bit of a mess, right? A random collection of numbers and letters, but it's not random at all. Think of it like a little puzzle. Once we put the pieces in the right place, it's going to make perfect sense. And here are the pieces. So first off, there's no minus sign in front, which tells us we're the buyer, we're long. The number 5, that's how many contracts we have. Now here's an important detail. One option contract almost always controls 100 shares. So 5 contracts means we're actually controlling 500 shares of the stock, which is GE, General Electric. SEP 11 means it expires in September 2011. The strike price is $20, and the last word, calls, tells us it's a call option, which is the right to buy. See? When you translate all that financial speak, it's actually pretty straightforward. What that whole line of code really means is this. The owner has the right, but remember, not the obligation, to buy 500 shares of GE stock at a locked-in price of $20 a share anytime between now and when it expires in September 2011. That's it. Simple as that.
Okay, so a logical next question is, where do you even find these things? Where do they live? Well, you find them on something called the option chain. The best way to think about it is like a giant restaurant menu, but for just one stock. It lists every single possible option you can trade on it.
And that's pretty much the textbook definition right there. It's just a big list. But when I say big, I mean it. For a single popular stock like GE, you could be looking at hundreds, maybe even thousands of different combinations of calls and puts, different prices, different expiration dates. The option chain is what keeps all of that organized so you can actually find what you're looking for.
So let's take a quick tour. When you first pull up an option chain, the very first thing you'll notice, right down the center, is this column of strike prices. This is the spine of the whole thing. It's the list of prices where you can agree to either buy or sell the stock.
Now, let's zoom out a bit. Flanking that central strike price column, you'll see the two types of options. By convention, almost every platform puts the call options on the left side and the put options over on the right. Calls on the left, puts on the right. This layout is pretty much universal, which makes things a whole lot easier.
Now, besides calls and puts, the other big way these things are organized is by time. The whole chain is broken up into sections based on the expiration date. So you'll see a whole set of prices for options that expire in June, then another whole set for July, another for August, and so on. It lets you pick your time frame.
And finally, let's get down to the money. Let's look at the prices. Just like a stock, you've got a bid price and an ask price. The bid is the highest price a buyer out there is willing to pay right now. The ask is the lowest price a seller is willing to take. The key thing to notice is that the gap between those two prices, the spread, can be a lot wider for options than for stocks, especially for the ones that don't trade very often.
So we know how to find an option. We know how to read it. But what is it actually worth? This brings us to a really important concept with a kind of funny name, moneyness. It sounds a little strange, I know, but all it is a way to describe where the option's strike price is relative to the stock's current price. And that relationship is everything when it comes to value.
First up, we have in the money, or ITM for short. An easy way to think about this is that the option is already a winner. If you could exercise it this very second, you'd make a profit on paper, just based on the prices. That immediate built-in value is called intrinsic value. It's real, tangible value. Let's make this super clear with an example. Say a stock is trading for $20 a share, and you own a call option that gives you the right to buy it for $15. Well, you've got an immediate $5 advantage, don't you? You can use your option to buy for $15, and the market says it's worth $20. That $5 difference, that is its intrinsic value. Now, the polar opposite of that is out of the money, or OTM. This is when exercising the option right now would be, well, a bad deal. It offers no immediate advantage. Because of that, we say an out-of-the-money option has zero intrinsic value, none. And here's why it's so obvious. Just flip the numbers. Let's say the stock is trading for $10. Your call option gives you the right to buy it for $15. So why on earth would you do that? You'd be paying $5 more than you have to. You just go to the open market and buy it for $10. The option offers no benefit, so it has no intrinsic value. And then, right in the middle, you have at the money, or ATM. This is when the option strike price is pretty much identical to the stock's current price. It's sitting right on the fence. And because of that, it has basically zero intrinsic value, but it's poised on a knife's edge, ready to tip into or out of the money. Okay, wow, we have covered a ton of ground here, from the buyers and sellers all the way down to the nitty-gritty of the option chain. So let's just take a second and boil all of this down to the most important things you need to walk away with. All right, let's lock this in. First, remember there's always a buyer who's long and a seller who's short. Second, the option chain is your menu for all available contracts. Now for moneyness. For a call option, in the money means the strike price is below the stock price. For a put option, it's the opposite. The strike is above the stock price. And finally, if an option is out of the money, exercising it right now would be a losing move. And that brings us to one last really interesting question to chew on. We just established pretty clearly that an out-of-the-money option has zero intrinsic value. It's got no immediate tangible worth. But if you go look at an option chain, you will see that it still has a price. It still costs money. So if it has no intrinsic value, what in the world are you paying for? What is that value? Well, that is a fantastic question and the topic for our next explainer. Thanks for joining me.
All right, welcome. Today, we're going to jump into a topic that, let's be honest, can sound super intimidating: financial options. But here's my promise to you. By the time we're done here, you're going to see that this whole complex world of options, it's really just built on simple ideas you already get from your everyday life. So let's break it all down. Now, I know what you're thinking. Starting with a quote from Fargo feels a little dramatic. But it's the perfect reminder that for every single options trade, there are two sides. There's a winner and there's a loser. And if you don't really understand the rules of the game, you can find yourself in a really tough spot financially. And that's the big question, isn't it? How do you make sure you're on the right side of that trade? The key is to really truly understand how these things are valued and how they work from the inside out. And that's exactly what we're going to do in this explainer. Give you the knowledge you need to use options as the powerful tool they can be, not as a trap. Okay, here's our roadmap. First up, we're going to use a simple pizza coupon to get our heads around call options. Then, we'll connect the dots from pizza to actual stock portfolios. After that, we'll talk about protecting your assets with something called a put option. We'll also peek behind the curtain at the other side of the bet, the seller. And finally, we'll wrap it all up with the key principles you absolutely need to remember. So let's get started with the most common type of option out there, the call option. And to do it, you can forget about complicated stock charts for a minute. All you need to think about is a coupon from your favorite local pizza place. So this is the textbook definition. A call option gives you the right to buy something. You don't have to, which is a key point, but you can. The price you get to buy it at is locked in. That's what we call the strike price. Now, this right isn't free, and it doesn't last forever. The fee you pay to own this right is called the premium, and it's got a shelf life, an expiration date. Okay, let's see how this maps directly to our pizza coupon. The thing you're buying, the underlying asset, is one large pizza. The locked-in price, your strike price, is the $10 printed on the coupon. The expiration date is pretty self-explanatory. And the premium? Well, imagine these coupons were so good that you had to buy them from someone. That cost is the premium.
So where does the value here really come from? Let's say that pizza normally costs $15 if you just walk in off the street, but your coupon lets you buy it for $10. Well, the basic, real, immediate value of that coupon is the difference, right? $5. In the world of options, we call that its intrinsic value, and we'd say this coupon is in the money. It's just simple arithmetic. And here's where things get really, really interesting. Okay, so that coupon is worth $5 in real savings right now. But what if somebody was willing to pay you $7 for it? Why would anyone in their right mind pay more than its actual current value? That extra $2 is what the pros call extrinsic value, or more commonly, time value. See, a buyer is willing to pay that extra $2 because they're making a bet. They're speculating. They're betting that in the time left before that coupon expires, the regular price of pizza might shoot up even more, making that coupon even more valuable. They are paying for the possibility of a bigger profit later. And this brings us to a really crucial point. As the buyer of that coupon, your risk is totally fixed. The absolute most you can possibly lose is the $7 you paid for it. That's it. But your potential reward? Well, technically, it's unlimited. If for some crazy reason a large pizza suddenly costs $100, that coupon is now worth a whole lot of money. This trade-off, limited risk for a shot at unlimited gain, is what makes buying options so incredibly attractive to so many people. Okay, that's enough about pizza for now. Let's take this same logic and apply it where it really matters, the stock market. You see, the biggest factor that determines that time value, that extra speculative bit of the price, is a concept called volatility. It's basically the market's way of pricing uncertainty. Let's look at a couple of real stocks, Johnson & Johnson and Monsanto, from a time when they were both trading at about $65 a share. Now, Monsanto was known to be a much more volatile stock. Its price tended to swing up and down a lot more wildly than a stable giant like J&J. And just look at the huge difference this makes in the option premium for a call with a $65 strike price. The market charged way, way more for the Monsanto option. This chart makes it crystal clear that extrinsic value, the part of the price that's pure speculation and time, is more than double for Monsanto compared to Johnson & Johnson. Why? It's simple. Because Monsanto is so much more volatile, there's a greater perceived chance of a massive price jump that would make the option pay off big. The market literally makes you pay a higher price for that higher level of uncertainty and that greater potential reward. So everything we've talked about so far has been about call options, which are basically bets that our price is going to go up.
But what if you're worried about prices going down? Well, this is where the other main type of option comes into play, the put option. And you know what? The absolute best way to think about a put is simply as a form of insurance.
A put option completely flips the script. It gives you the right, but again, not the obligation, to sell an asset at a predetermined, locked-in price. It's your financial safety net. If you own a bunch of stock and you're worried the market might tank, you can buy a put option to protect yourself on the downside. It works just like buying insurance for your house.
So let's say you own a home worth $500,000. That's your big asset, the valuable thing you want to protect. Think of it just like a large stock portfolio. For a lot of us, it represents a huge piece of our financial well-being. Now, to protect that house against a potential disaster like a flood, you buy an insurance policy. Maybe it costs you $300 for the year. That's your premium. This is the exact same logic behind buying a put option. You are paying a small, fixed, known cost, the premium, to protect yourself from a huge, potentially catastrophic loss on a much, much larger asset. So let's make sure we're perfectly clear on how these are different. A call option, your right to buy, becomes valuable, it goes in the money, when the market price rises above your locked-in strike price. This lets you buy it cheap. A put option is the exact opposite. Your right to sell becomes valuable when the market price falls below your strike price, because it lets you sell it for more than it's actually worth. Now, this is so important to remember. Options are not just created out of thin air. For every single person buying that pizza coupon or buying that insurance policy, there has to be someone on the other side of the transaction selling it to them. For every option buyer, there is an option seller, who is often called the writer. You have to understand these two sides have completely opposite goals and, critically, opposite risk profiles. The buyer pays the premium, and they're hoping for a big, dramatic price move. Their risk is limited to whatever they paid. But for them, the ticking clock, what traders call time decay, is their worst enemy. Every day that passes is one less day for their big prediction to come true, and that option's value just sort of melts away. The seller, on the other hand, is the one who collects that premium. That payment is their maximum possible profit. They are betting that the big price move won't happen. For them, time decay is their best friend, because every day that goes by makes it more and more likely they get to just keep the whole premium. Okay, we have covered a ton of ground here, from pizza coupons to insurance policies to volatility. So let's boil it all down into the most important, must-know principles you should walk away with. This is really your key takeaway. If you are buying a call option, just burn these 4 things into your brain. Number 1, you are bullish. You need the price of the asset to go up. 2, your break-even point isn't just the strike price, it's the strike price plus the premium you paid. 3, your maximum loss is capped at that premium. And 4, your profit potential is, in theory, unlimited. And if you're buying a put option, the rules are basically a mirror image. 1, you are bearish. You need the price to go down. 2, your break-even is the strike price minus what you paid for the premium. 3, your max loss is, again, just the premium you paid. And 4, your maximum possible gain is limited, but it's still huge. It's the entire strike price, which would happen if the stock went all the way to 0. And so we end right back where we started, with a fundamental choice. Are options a tool for high-stakes speculation, or are they shield for careful protection? The truth is, they're both. They can be your lottery ticket, like that pizza coupon, or they can be your homeowner's insurance policy. The difference, and the real secret to staying out of that wood chipper, isn't in the option itself. It's in the knowledge, the strategy, and the intention of the person who's using it. Thanks for tuning in. Have you ever looked at your investment portfolio and just felt like you were staring into a black box? I mean, you know you're taking on risk, but how much risk exactly? And what does it even look like? Well, what if I told you there's a way to turn all that uncertainty into a single, clear picture? That's what we're going to do today with risk graphs. We are going to learn how to visualize your financial exposure so you can make smarter, more confident decisions. You know that classic line from Jaws? You're going to need a bigger boat. It's kind of the perfect metaphor for what can happen to an investor. You think you're in a safe position, right? Just dipping your toes in the water. But then the market turns on a dime, and you suddenly realize the shark you're facing is way bigger and a lot more dangerous than you ever imagined. That's that sinking feeling you get when you realize you've completely underestimated your risk. And that's exactly where risk graphs come in.
They take the abstract, often invisible idea of financial risk and they make it real, something you can actually see and understand. With a risk graph, you can map out the potential profit and loss of any investment before you put a single dollar on the line. From simple stocks to complex options, today we're going to learn how to see it all. So how do we actually start building one of these things? Well, we're going to start with the most fundamental building block of pretty much any portfolio, just owning shares of a stock. The math is simple, but it's the foundation for, well, for everything else we're going to talk about.
Let's start with a really simple example. Let's say you buy 100 shares of ExxonMobil at $83 a share. That's an $8,300 investment. Now, just look at the table. If the stock price drops to 74, you're down $900. If it climbs up to 92, you've made $900. It's a straight one-to-one relationship. For every dollar the stock moves, your profit or loss changes by $100. Simple enough, right? Now here's where it gets cool. When we plot those numbers on a graph, we get this, a simple, straight line, sloping upwards. The vertical axis, the up and down one, that's your profit or loss, and the horizontal axis, that's the stock price. See how as the stock price moves to the right, your profit just keeps climbing? Theoretically, it's unlimited. But if the stock price drops, your loss is limited to what you put in, because hey, a stock can't go below zero. This upward sloping line is our first fundamental shape. Okay, so we've seen what it looks like to bet on a stock going up. Now let's look at the flip side. Betting on a stock going down. This is called shorting. In this case, we've shorted 150 shares of GE at $20 a share. We want the price to fall. If it goes all the way to zero, which would be amazing for us, we make our maximum profit of $3,000. But what happens if the price goes up? That's where things get risky. And here is the risk graph for that short position. It's a perfect mirror image of owning the stock, a downward sloping line. Your potential profit is capped, right? The stock can only go to zero, so that's your max gain. But look at the other side. As the stock price rises, your losses are, in theory, unlimited. That line just keeps going down and down and down. This, right here, is what unlimited risk looks like. It's a pretty sobering picture, and it's exactly why shorting stock can be so incredibly dangerous if you don't manage it carefully. All right, so we get the straight lines of long and short stock. Now it's time to introduce a whole new set of tools, options. Think of options like financial Legos. Seriously, each one has a unique shape, a unique risk profile, and we can combine them to build just about any kind of investment strategy you can imagine. So our first Lego piece is the long call. A call option gives you the right, but not the obligation, to buy a stock at a set price. And look at this risk graph. It's often called a hockey stick shape. Your maximum loss is totally defined. It's just the price you paid for the option, which we call a premium. That's the flat part of the hockey stick. But once the stock price gets above your set price, your profit potential is unlimited, just like owning the stock. This is why people love calls. You get all that upside potential with a strictly limited risk. Next up, we've got the long put. This gives you the right to sell a stock at a set price. And as you can probably guess, its risk graph is the mirror image of the long call. Again, your maximum loss is capped at whatever you paid for the option. But in this case, you start making money as the stock price goes down. This makes it a great tool for betting against a stock, or, as we're about to see, for protecting the investments you already have. Now, for every person buying an option, there has to be someone on the other side selling it. When you sell an option, your risk profile is the exact opposite of the buyer's. Take the short call. You do this to collect that premium, the cash, right up front. That cash is your maximum possible profit. But your risk? It's unlimited, just like being short the stock. Now, with a short put, again, your max profit is the premium you collect. But your risk is that you might be forced to buy the stock at that higher price, even if it's trading way lower. Your potential loss is huge, all the way down to zero. Okay, this is where it all comes together. This is where the real power of these graphs shines. We've learned the basic shapes of stocks and options. Now it's time to start combining them, stacking these financial building blocks on top of each other. This is how we can create custom risk profiles that are tailored perfectly to what we think the market's going to do and how much risk we're willing to take. So let's walk through a real-world example, building a hedge. Let's say you own those 200 shares of ExxonMobil at $83. You're bullish on the company long-term, but you're a little worried about a market dip in the near future. So to protect yourself, you can buy one of our building blocks, a long put, with a strike price of 75. This put is basically an insurance policy against a big drop in the stock.
So what does our new hedged position look like on a risk graph? It's actually way simpler than you might think. We just add the two individual graphs together. You literally stack them up. We take that upward sloping line from our stock and we combine it with the hockey stick shape of our long put. And what we get is this new hybrid shape. We've effectively bent the risk profile to our advantage.
And here is the payoff. Look at this. Without the hedge, if the stock dropped to $67, we'd be looking at a $3,200 loss. But with our put option in place, that loss is cut down to just $1,900. Why? Because once the stock price falls below our $75 strike price, that put option starts making money, which offsets a big chunk of the losses from our stock. We haven't gotten rid of the risk, but we've absolutely cushioned the blow. Now, of course, this protection isn't free. It cost us the premium we paid for the put, but for a lot of investors, that's a price well worth paying for some peace of mind.
Now, MISC graphs are an incredibly powerful tool, but it's really important to remember that they are a simplified model of reality. They give us a fantastic snapshot of our potential profit and loss at a very specific point in time, usually the exact moment our options expire. But there's some important fine print, a few things they don't show us. For example, these basic graphs don't factor in any dividends you might receive, which would boost your return. They also don't account for corporate actions like a stock split. And maybe the most important thing they leave out is the effective time itself. In the real world, an option's value changes every single day because of something called time decay. It adds another layer of complexity, for sure, but the good news is that you can visualize that too with more advanced risk graphs. So, what's the bottom line here? Risk graphs are a simple, but I think a profoundly powerful tool for seeing your financial exposure. They turn what can feel like a confusing mess of numbers and different positions into a single, easy-to-understand picture. And, like they say, you can't manage what you can't measure. Well, risk graphs give you the power to not only measure your risk, but to actually see it in a whole new way. Ultimately, this is about giving you power. It turns you from being a passive passenger into the architects of your own financial future. Once you understand these basic shapes, the lines, the curves, you can start combining them in creative ways that fit your exact view of the market and exactly how much risk you're willing to take. So the only question left is, what are you going to build? You know, we insure everything that's important to us, right? Our homes, our cars, our health. But what about what's often our single largest financial asset? Our investment portfolio. Well, today we're going to break down the investor's insurance policy, a really powerful strategy for protecting what you've built. Let's get right into it. So here's what we're going to cover. First, we'll ask the question, is insuring your portfolio even a real thing? Then, we'll dive right into the mechanics of a strategy called a married put. We'll look at what it costs, how to pick the right one, why time is so critical, and finally, the incredible edge this gives you as an investor. All right, let's get right to the heart of the matter. We are all taught that investing means taking on risk. It's just part of the game. But what if I told you there was a way to build a legitimate safety net under your investments, just like you do for all your other major assets? I just love this quote from Fried Green Tomatoes. Kathy Bates' character, Evelyn, she just gets it. Being properly insured gives you this certain confidence, this freedom to act. Now, we're not talking about ramming cars in a parking lot, but the core idea is exactly the same. When you know and control your downside, you can operate with a whole lot more confidence. And this really is the fundamental question, isn't it? It just seems so logical. We've got these huge, sophisticated markets for almost every kind of insurance you can imagine. So why not for our biggest asset? Well, I've got great news. The answer is a resounding yes. That market does exist, and it's all built around a financial tool called options. So let's pull back the curtain and see how this portfolio insurance actually works. The strategy at the heart of it all is called a married put, and we're about to dissect it piece by piece. You know, at its core, it's actually surprisingly simple. You buy shares of a stock you want to own for the long haul, and at the exact same time, you buy a special type of option called a put option. That put option gives you the right to sell your stock at a guaranteed price. The two positions are linked, or married, right from day one. Okay, so here's what that looks like in the real world. Let's say you go out and buy 100 shares of General Electric. At the same moment, you buy one GE put option contract with what's called a strike price of $17. Now, that little contract gives you the right, not the obligation, but the right to sell your 100 shares for $17 apiece, no matter how far the stock might fall.
It's your guaranteed exit door. And here is where the magic really happens. Just watch that last column, total investment value. See, as the GE stock price drops below our $17 strike price, the value of our put option starts to climb. It perfectly offsets the loss in the stock dollar for dollar. Your total position value literally cannot go below $1,700. That is your insurance policy kicking in.
But of course, just like any insurance policy you've ever bought, this protection isn't free. There's a cost involved, a premium you've got to pay. So now let's take a closer look at the price of that protection and what it means for your overall risk and reward.
It's really straightforward. The cost of this entire strategy is simply the price you pay to buy that put option. In the options world, we call that the premium. This is the amount you pay upfront for the incredible peace of mind that comes with knowing your absolute worst-case scenario. It's an extra cost for sure that an unprotected stock position doesn't have. This table right here, it makes the trade-off absolutely crystal clear. So let's say we bought the stock at $17.50, and that put option costs us $1 a share, or $100 total. Now, on the upside, sure, the married put makes $100 less profit because we had to pay for that insurance. But look at the downside. The unprotected stock just keeps bleeding money, down $150, down $350, on and on. And the married put, its loss stops dead in its tracks at $150. It physically cannot go any lower. Now that is the power of a hedge.
And this chart just visualizes that perfectly. That first bar, the unprotected stock, its potential loss is theoretically infinite. It just keeps going down. But that second bar, our married put, it slams right into a solid floor. Your maximum loss is defined. You know it from the second you put on the trade. You've essentially taken catastrophic risk completely off the table.
Okay, so we know what a married put is. But now, how do you actually build one? Well, the single most important decision you're going to make is picking the right strike price for your put option. And this isn't guesswork, folks. It's a calculated decision, and it's based on two really key metrics. The easiest way to think about this is to go right back to car insurance. The downside percentage, or DP, that's basically your deductible. It's how much of a loss you're willing to handle yourself before you call the insurance company. The cost percentage, or CP, well, that's your premium. It's the check you write to get the policy. And just like with car insurance, these two things are always linked. If you want a lower deductible, you're going to pay a higher premium. It's that simple. And that thinking leads us to this crucial rule of thumb. It's just simple, sound financial logic. The cost percentage of your insurance should always be less than the downside percentage you're protecting yourself from. Think about it. You would never pay more for insurance on your car than the car is actually worth. Same principle applies here. Let's look at a real-world example here. We've got IBM, a big, stable blue-chip stock, against Baidu, a much more volatile tech stock. Now, to get roughly the same level of protection, about a 9 to 11% downside, look at that cost difference. The insurance on Baidu is literally twice as expensive. It costs 8% versus just 4% for IBM. The market is telling you loud and clear that Baidu is a much riskier ride, so the premium for its insurance is way higher. And the great part is, you can fine-tune this. Looking at IBM, you could pick a put with a $150 strike price. That gives you a 9% downside for a 4% cost. Not bad. Or you could choose a 155 strike. Now notice the trade-off. Your cost only goes up by one little percentage point from 4 to 5%, but you slash your potential downside from 9% all the way down to just 6%. For a lot of people, paying an extra 1% to cut your risk by a third, that's a trade you take all day long. All right, so the second huge decision, right after picking your strike price, is deciding how much time you want to buy. The expiration date on your put option is an absolutely critical piece of this strategy. And the rule of thumb here is as simple as it is effective. Buy yourself at least 6 months of time. You want to push that expiration date out. This lines up your insurance policy with a proper long-term view on your investment. And as you're about to see, it helps you sidestep the biggest trap of short-term options. So, why so far out? Well, a huge piece of an option's price is something called time value. Think of it like a melting ice cube. The further away the expiration date, the bigger the ice cube. Now, that time value is always melting, but it melts really, really slowly for options that are far out in time. It's in that last month, that last 30 days, that the melting becomes incredibly fast. It just falls off a cliff. We want to be on that gentle, slow melting part of the slope, not standing on the edge of the cliff. So let's bring all this home. What's the single biggest, most powerful advantage of using a married put? At the end of the day, what is the edge that this gives you as an investor?
It all comes down to one powerful three-word concept: capital at risk, or CAR. A married put defines with 100% certainty the absolute maximum amount of money you can possibly lose on that trade. And that one simple fact, it completely transforms investing from a game of hope and fear into a calculated exercise in risk management.
So to quickly wrap it all up, a married put marries a stock and a put option to create an absolute floor for your investment. Think of it exactly like insurance, using those downside and cost percentages to pick your deductible and your premium. Always, always buy yourself at least 6 months of time. And remember, the entire goal of this whole thing is to define and limit your capital at risk before you ever put a single dollar into the market.
And that really leads us to the final thought I want to leave you with. See, this isn't just about avoiding losses. It's about enabling confident action. When the fear of a catastrophic market drop is just taken off the table, how does that change your entire approach? If you knew with certainty your absolute worst-case scenario right from the start, what kind of portfolio would you finally have the confidence to build for your future?
All right, welcome to The Explainer. So today, we are going to break down a really powerful strategy for managing your investment risk. It's called the collar. You know, if you've ever owned a stock that you absolutely love, but you just can't shake that nagging feeling in the back of your head that it might take a nosedive, well then this one is definitely for you. I love this quote from Clint Eastwood. It perfectly frames what we're talking about today. I mean, obviously he's not talking about the stock market, but the feeling behind it, it's spot on. Because look, successful investing isn't really about having a crystal ball and predicting the future, right? It's about controlling your position within a market that you know is going to be unpredictable. And a strategy like the collar, well, it gives you exactly that control.
So let's dive right in. Let's talk about that classic investor's dilemma. I'm sure you've been there. You've got a stock, you've got a nice gain in it, and you really believe in the company long term. But you're getting a little nervous. You see some short-term choppiness in the market. You want to lock in those profits, but you absolutely do not want to sell the stock and then watch it rocket higher without you. So what do?
Well, one of the go-to moves is to buy what's called a protective put. And you can think of it as just straight up insurance for your stock. Simple as that. If the stock price drops below a certain point, that put guarantees you can sell your shares at that higher protected price. Sounds great, right? But what's the one problem? Just like any insurance policy, it costs money. It has a premium. And that cost eats directly into your profits. And that's exactly where the collar comes in. It is such a clever strategy because it gives you a way to get that exact same protection, but without that high price tag. And get this, sometimes you can even get it for free.
Okay, so that brings us to the collar itself. The way I like to think about it is, it's like you're building a fence around your stock's performance. You're literally setting a floor, a point below which you just cannot lose any more money. But, and this is the trade-off, you're also setting a ceiling, a point above which you can't make any more money either. It's all about creating a strategy with totally defined outcomes.
So let's get technical for just a second. What exactly is a collar? It's really a three-part play. First, you've got to own the stock, at least 100 shares. Second, you buy that protective put. That's your insurance, your floor. And then, and this is the really key part, at the same time, you sell, or what we call write, a covered call option. That call brings in some cash, some income, and that sets your ceiling. And that income from the call, that's what you use to pay for the put.
Okay, let's actually build one, step by step. I promise it is way simpler than it sounds. So step 1, that's the foundation. You already own the stock. Check. Step 2, you buy your insurance policy. That's the protective put. And step 3, this is how you pay for it all. You sell off a little bit of your potential upside by writing that covered call. And that's it. Those 3 simple pieces come together to create this really powerful collar around your investment.
All right, to make this really concrete, let's use a real-world example. We'll use General Electric. So let's imagine you own 100 shares of GE, and right now it's trading at, say, $17.50 a share. You're feeling a bit cautious, so you decide to buy a put with a $17 strike price. Now to pay for that put, you sell a call option with a $20 strike price. Boom. Just like that, you've officially placed a collar on your GE stock.
Now this table, this is where you can really see the magic of the collar in action. Just focus your eyes on that total column all the way on the right. See what happens? If GE just rockets up to $22 a share, the total value of your position is capped right there at $2,000. Why? Because that call you sold means you have to sell your shares at the $20 strike. Now look at the other side of the coin. Look at the bottom. If GE totally plummets down to $16, your total value is floored at $1,700. Your put gives you the right to sell at $17.
See that? Your risk and your reward are now perfectly contained inside that fence.
Okay, now let's factor in the costs to see the real bottom line. Let's say the stock originally cost you $17.50. The put cost you $100, but that call you sold, that brought in $50. So your total initial cost for the whole position is $1,800. And this table just lays out the profit and loss so clearly. It doesn't matter how high GE goes, our profit is locked in at $200. And no matter how far it falls, our loss is stopped cold at $100. The volatility has been completely tamed.
So let's just zero in on that upside for a second. Your absolute maximum profit on this trade is locked in at $200. Now, based on your initial cost of $1,800, that's a potential 11% return. Not bad. But the key thing here is the certainty. You know your absolute best case scenario the second you put the trade on.
And this right here is the whole reason we do this. This is the crucial point. Your maximum possible loss is just $100. That's a 5.5% risk on your capital. Think about that. No matter what GE does, even if the company goes to zero, you cannot lose more than $100 on this position. That is the power of a defined risk hedge.
Okay, so that GE example was perfect for understanding the mechanics, right? But it brings up the single most important question. How do you decide where to set your own floor and ceiling? How do you strategically pick the right strike prices to build a collar that fits your goals, your risk tolerance?
Well, there's a really simple but powerful framework we can use. I want you to think of it as 3 key percentages. These are like the 3 main levers you can pull to design the exact risk and reward profile that you're looking for. We call them the upside percentage, the downside percentage, and the cost percentage.
First up, we have the upside percentage, or just UP. All this does is measure how much room you're giving the stock to run before your profit gets capped. So going back to our GE example, the stock was at $17.50 and we sold the $20 call. That gives us an UP of about 14.3%. It means you were willing to let the stock climb that much before you had to sell.
Next, we have the downside percentage, or DP. This is just the flip side of the coin. It tells you exactly how much risk you're willing to take on. How far the stock can fall before your insurance policy kicks in. In our GE trade, with the stock at $17.50 and our put at 17, the DP was just 2.9%. Think about that. You are only risking a tiny 2.9% drop.
And finally, we've got the cost percentage, or CP. And honestly, this is the real heart of the collar strategy. It just calculates the net cost of your protection. You take what you paid for that put, you subtract the money you brought in from selling the call, and you see what's left over. For GE, our net cost was only $50. Just think about that for a second. By selling that call, we literally slashed the cost of our insurance in half.
Okay, let's take this framework and apply it out in the wild. Because here's where it gets really fascinating. The way collars work, their dynamics, it all changes based on the personality of the stock you're trading, and specifically how volatile it is.
So here's the classic challenge, right? Buying insurance, that put option, on a really volatile, swingy stock is super expensive. The premiums are high. But, and this is the beautiful part of the collar, that same high volatility that makes the put you're buying expensive, it also makes the call you're selling way more valuable. That volatility can actually become your biggest advantage.
Let's compare 2 different collars to see this in action. On one side, we've got a stable, low-volatility stock like IBM. On the other side, a much more volatile name, the Chinese tech company Baidu, or BIDU. Now, we've set them up so the upside and downside percentages are roughly the same, around 9 to 11% for both. But just look at the huge difference in the cost percentage, the CP.
And here is the incredible result. For that stable stock, IBM, you still end up with a net cost of about 1%. You're paying a small premium for your protection. Fine. But look at BW, the high volatility stock. The income you got from selling that call was so massive that it completely paid for the expensive put, and it left you with a net credit of 2%. You literally got paid to protect your stock. This, my friends, is the holy grail of this strategy. We often call it a costless collar, and it is an absolute game changer. All right, there's just one last strategic layer we need to talk about, and it's a big one: time. Specifically, how you time the expiration dates of the options you're buying and selling, because trust me, it can make a huge difference to your bottom line.
So typically with your insurance, the put, you want it to last a good long while, right? Maybe 6, 9 months. But what about the call you're selling? Remember, time decay, or theta, works against people who buy options, but it works for people who sell them.
So this table shows the difference. What if you sell one 9-month call versus selling a new 1-month call 9 separate times? For a low volatility stock like IBM, it's actually better to just sell the single long-term call. But look at volatile BIDU. Selling those short-term calls over and over again could potentially generate almost double the income. That's huge.
Okay, let's bring this all home. What's the big takeaway here? It's that a caller is this incredibly flexible tool for taking control of your investments. It lets you define your exact risk and your exact reward. It lets you use the premium from selling a call to pay for that protective put you need. You can use that 3% framework, UP, DP, and CP, to structure any trade exactly how you want. And maybe most powerfully of all, you can take a stock's high volatility, which most people see as a bad thing, and you can turn it from a liability into an asset that literally funds its own protection.
So that really just leaves us with one final thought. Look, we all know you can't control the market. It's fundamentally unpredictable. But the ability to take a position and precisely define its boundaries, to know with absolute certainty what your best day and your worst day look like from the moment you start, well, that's not just a defensive move, that's the ultimate form of control.
Welcome to The Explainer. So let me ask you a question. What if you could get all the upside of owning 100 shares of a stock you love, but you could do it for just a tiny fraction of the cost? Well, today, we're going to break down a really powerful investment strategy that promises exactly that. Big league exposure for a minor league price.
You know, I just love this line from the movie Stripes because it perfectly, and I mean perfectly, captures the whole spirit of what we're about to explore. I mean, think about it for a second. Why go out and buy the expensive shoes if a really good shine can make the ones you have look just as good? In the world of investing, that's a fascinating question. Why tie up all your cash buying a stock outright when a different tool can give you almost the exact same look and feel? I think this is a dilemma that pretty much every investor has faced at some point. You're bullish, you see the potential in a stock, but man, tying up a huge chunk of your capital just feels heavy. Not to mention the risk. If you're wrong, that whole investment can take a serious hit. So today, we're going to unpack a pretty sophisticated solution to this exact problem. All right, here's our roadmap for this explainer. First, we're going to dive into the core idea, that $100 shine. Then we'll get into the nuts and bolts, the anatomy of the trade itself. After that, we'll put it all to the test with a real-world example. From there, we'll build out a strategic playbook you can actually use, and finally, we'll wrap up by weighing some of the finer points and trade-offs. So let's get into it. Okay, so what exactly is this stock replacement strategy? Well, at its heart, it is all about one thing: control. Instead of actually buying 100 shares of a stock, you're using a specific financial tool to control those 100 shares. This gives you that upside you're looking for, and this is really the key part, it comes with a built-in safety net.
So here's that classic challenge, right? You've done the homework, you have a really strong feeling a stock is headed up, but buying 100 shares just requires a massive amount of cash. And if you're wrong, well, that entire pile of cash is at risk. The goal here is to find a smarter, way more capital-efficient way to make that exact same bullish bet.
Okay, so we've laid out the problem. Now let's look at this specific tool that makes this whole strategy possible. See, to pull this off, you can't just use any old call option. Nope, you need a very specific type, one that's almost tailor-made to act just like the stock itself.
And that brings us to our key tool, the deep in-the-money call option. So what does that mean? Well, simply put, its strike price is already way, way below the stock's current price. This gives it what's called intrinsic value. It has real, concrete value right this second, not just value based on a hope for the future. And because of that, it moves almost perfectly in lockstep with the stock, which is exactly what we want.
This chart really makes the difference crystal clear. See, options that are at the money or out of the money get almost all of their value from what's called time value, which is really just a bet on where the stock might go. That's pure speculation. For this strategy, we ignore those completely. We focus exclusively on the in-the-money call. And why is that? Because most of its value is real, it's intrinsic, making it the absolute closest and safest substitute for actually owning the stock. Okay, enough theory. Let's see how this actually works in the real world. We're going to use a really solid example with one of the most popular ETFs out there, the S&P 500 ETF, symbol SPY. This is going to make the numbers and the benefits just pop right off the screen. All right, let's put some real numbers on this. Let's just imagine the SPY ETF is trading at $130 a share. So to buy a standard block of 100 shares, you'd have to put up $13,000 of your own capital. That is a serious chunk of change. Just keep that number in your head for a second. 13 grand. Now, look at the alternative. Instead of buying those shares, you buy one single deep in the money call contract. It still controls those same 100 shares. But in this example, that contract costs you just $1,550. I mean, let that sink in for a moment. We went from $13,000 of capital on the line down to just over $1,500. That is a massive, massive difference. And this table, this is where it all comes together beautifully. First, look at the downside. If the stock just tanks, the shareholder is down $3,000. Ouch. But the call option holder? Their loss is capped at the $1,550 they paid. That's it. Period. Now for the fun part, the upside. If the stock rallies to 150, the shares are up a pretty respectable 15%. But the call option, because of that tiny amount of capital you put in, is up an incredible 113%. That, my friends, is the power of smart leverage. And this right here shows you that built-in safety net perfectly. The strike price, in this case $117, it acts like a hard floor under your investment. Once the stock falls to that level, you literally cannot lose another penny on that option. The stockholder, on the other hand, they are still losing money with every single tick down. Having that risk clearly defined from day one is an incredibly powerful feeling.
Okay, so the power of this strategy is pretty clear. But now comes the big question. How do you actually choose the right option? I mean, there are dozens of strike prices, different expiration dates. You can't just throw a dart at a board. So let's build a simple 3-step playbook to make sure you're making a smart, calculated choice every time. It all boils down to knowing 3 key numbers before you even think about placing a trade. We're going to call them CAR, for capital at risk, BEP, for break-even percentage, and DP, for downside percentage. If you can get these 3 right, you'll understand the entire risk-reward profile of your position. Let's dig into each one. So here's your toolbox. Capital at risk, or CAR, is the easy one. It's just the total price you pay for the option. That is your absolute worst-case scenario loss. The break-even percentage, or BEP, tells you how much the stock has to rise just for you to get your initial investment back. And the downside percentage, or DP, this one's my favorite, that's your safety cushion. It's how far the stock can drop before you even start to feel the pain and approach that max loss. And this is where that framework becomes so incredibly powerful. Just look at the trade-offs. If we go really deep in the money without 105 strike, our cushion is huge, right? 19%. But it's expensive. Now, if we go for the cheap 125 strike, our cushion shrinks to a tiny 4%. But look right there in the middle, that 115 strike. That looks like the sweet spot. The cost is reasonable, we've got a solid 12% cushion for error, and we only need the stock to move up 1.8% to break even. That is a balanced, calculated trade. We're almost home, but let's cover a few final, and I mean absolutely crucial points to make sure you're approaching this strategy with the right mindset and you fully understand all the details. This isn't just about the mechanics, it's about the bigger picture. Now, what's really fascinating here is that our strategy has an identical risk profile to another popular one called the married put. That's where you buy the stock and also buy a put option as insurance. The risk is exactly the same, but just look at the difference in capital. The deep ITM call is so much cheaper. Of course, there are always trade-offs. With the call, you give up any dividends the stock pays, and your profits are usually going to be taxed at higher short-term rates. It's really important to weigh these factors. And finally, just a few quick tactical points. First, give yourself time to be right. Choose an expiration date that's at least 6 months out. Second, don't let the clock run out on you. About a month or two before expiration, you can roll the position, which just means you close your current option and open a new one farther out in time. And third, and this is a big one, always remember dividends. If you're giving up a nice dividend by using an option instead of the stock, you have to count that as part of your cost. And please, if you remember nothing else from this explainer, remember this. The strategy we've laid out today is a hedging strategy. It's about replacing stock in a smart, capital-efficient way. The absolute second you are tempted by those cheap, out-of-the-money lottery tickets, you have abandoned the strategy completely. You are no longer hedging, you are purely speculating. And trust me, that is a completely different game with much, much higher risk. So let's bring it all home.
The core lesson here is this. Deep in the money calls let you control 100 shares with a fraction of the cash and with a risk that is clearly defined and capped from day one. By using our simple three-part framework, CARE, BEP, and DP, you can make a smart, informed decision. And most importantly, always remember what this tool is for. It's for smart hedging, not for wild speculation.
And that's really the final thought I want to leave you with. This strategy provides a really powerful way to make your capital work more efficiently, all while managing your risk. So the question is it the right fit for your portfolio? That's something to consider. Thanks for joining me for this explainer.
You know, exchange-traded funds, or ETFs as we all call them, have truly had their moment in the spotlight over the last decade. I mean, they've grown from this kind of niche product into one of the most popular investment tools on the entire planet. And today, we're going to see exactly why they deserve a starring role in your portfolio.
It's kind of like that famous line from the old movie, "The ETF is ready for its close-up." But look, this isn't just about being popular. This is about a fundamental shift in how we invest, giving everyday investors like you and me access to strategies that were once, well, incredibly difficult, if not flat-out impossible to pull off.
All right, so here's the game plan. We're going to start by taking a look back at the kind of clunky world before ETFs. Then we'll get into their revolutionary arrival, we'll break down their key advantages, see how they can be the ultimate hedging tool, figure out where to find them, and then we'll finish up with a seriously powerful pro tip called pseudo-hedging.
To really appreciate just how much of a game changer the ETF is, we have to understand the problems it actually solved. So let's take a quick trip back in time.
Think about it. Just 10 years ago, the investment world was a totally different place. If you wanted to get broad exposure to the market, you were pretty much stuck with mutual funds. And that meant dealing with higher fees, you could only buy or sell at whatever price was set at the end of the day, and you had almost no good way to hedge your positions. It was a really clunky, restrictive system for the average investor.
And then, the hero of our story arrived on the scene, and it completely changed the game. This was the evolution of the ETF marketplace.
So what exactly is an ETF? Well, it's a security that tracks a whole collection of assets, like an index fund does, but with one absolutely crucial difference. It trades on an exchange all day long, just like a stock. You're not waiting until 4 p.m. to get your price. You get a live price, a bid, and an ask all throughout the trading day. And boy, was this a revolution people were waiting for. The growth has been nothing short of explosive. In just the first quarter of 2011, total assets in ETFs blew past $1 trillion for the first time ever. That's one of the fastest growing products in the history of finance.
Now let's get into the nitty-gritty of why ETFs got so popular. It really comes down to a set of what I like to call superpowers that give investors just incredible flexibility and control, especially compared to their older cousins, the mutual funds.
This slide here really lays it all out, side by side. So over on the left, you got mutual funds. We are stuck with one price, set at the end of the day. But with ETFs, on the right, they trade all day, just like a stock. And check out the cost difference. Mutual funds often have higher fees and make you put in a minimum amount of cash. With an ETF, costs are generally lower, and you can buy as little as one single share. And this last one, this is huge for active investors. You can short an ETF or buy it on margin. That's flexibility you just don't get with a traditional mutual fund.
But out of all those advantages, there is one that stands above the rest. And I want you to let this one sink in for a second. The single most important benefit, especially if you're a sophisticated investor, is that many ETFs have options that trade on them. No mutual funds have this. And this one capability is the key that unlocks some incredibly powerful risk management strategies.
And the benefits, they don't stop there. ETFs give you incredible diversification, from the broadest market indexes all the way down to the tiniest little subsectors. They have low costs because they're passively managed by computers, not by expensive fund managers. They're also more tax efficient, and the sheer variety of them lets you custom build a portfolio to your exact specifications. It's fantastic.
Okay, so we've covered the powerful features of ETFs, especially the options part. Now let's see how we can actually put those features to work in a really powerful strategy for managing your portfolio.
So the crucial point is this. Because of their structure, their low cost, and the fact that you can get options on them, ETFs are the perfect vehicle for a strategy called buy and hedge.
And this really shows you the two sides of the coin. On the buy side, you use these broad, diversified, low-cost ETFs to build the core of your portfolio, your stocks, your bonds, the whole shebang.
Then, on the hedge side, you use options on those very same ETFs to protect your investments and manage your downside risk. It's an elegant and really effective 1-2 punch.
Okay, this all sounds great in theory, but where in the world do you actually find these things? Well, believe me, it is much, much easier than you might think.
The internet has completely leveled the playing field here. You can use free online screeners from sites like Morningstar to find ETFs that fit whatever criteria you have. Your own online broker almost certainly has a free ETF information center. And you can always go straight to the source, the websites of the big ETF issuers themselves.
And when you start looking, you're going to see a few names over and over and over again. The ETF market is really dominated by a handful of major players. The 5 largest issuers you see here, iShares, State Street's SPDRs, Vanguard, PowerShares, and ProShares, they account for a staggering 91% of all assets under management.
And here they are, the titans of the industry. This table shows the biggest ETFs by assets from back in June of 2011. You see the SPDR S&P 500, ticker SPY, right at the top. You've got funds for gold, emerging markets, international stocks. These are the big, liquid funds that form the foundation of so many portfolios.
All right, now for our advanced tip. This is where we can get really clever with ETFs to solve a very common and often expensive problem for investors.
So, picture this scenario. You found a stock you absolutely love, but it either doesn't have any options available or, and this happens a lot, the stock is so volatile that the options are incredibly expensive to buy for protection. So what do? Well, you can create what's called a pseudo-hedge.
Let's break this down with a real-world example, right from the slide. Step 1, you pick your stock. Let's say it's Apple. You love the company, but its options are just too pricey. Why? Well, because the stock is volatile. It moves around a lot, and higher volatility means more expensive insurance, which is basically what an option is. So step 2, you find a cheaper proxy. Instead of buying options on Apple, you look at the broader tech sector ETF, ticker XLK. It's less volatile, so its options are cheaper. Step 3, you do the math. You figure out the price ratio between Apple stock and the XLK ETF, which in this case is about 13-to-1. Step 4 is the action. For every 100 shares of Apple you own, you buy 13 put contracts on the cheaper XLK to act as your hedge. But in step 5 here is critical. You have to know the risk. This isn't a perfect shield. It protects you if the whole tech sector goes down, but it's not going to save you from a problem that's unique to Apple itself.
So let's wrap this all up. What are the key takeaways here? First, ETFs are a fantastic, low-cost way to build a diversified portfolio. Second, ETFs that have options trading on them are a total game changer for hedging and managing your risk. Third, you can get creative and use a pseudo-hedge with sector ETFs as a cost-effective, though not perfect, alternative. And finally, just remember this entire way of investing was simply out of reach for most of us just a decade ago.
The ETF has had its close-up, and it has delivered a blockbuster performance, fundamentally changing the investment landscape for all of us. The only question left is your portfolio ready to give this versatile star a leading role?
If you've ever watched the market start to dip and felt that little knot of anxiety in your stomach, you know exactly what I'm talking about. Well, today we're going to tackle a professional-grade strategy to help you protect your entire portfolio when things get choppy. Think of it as building a fortress around your hard-earned investments using one single powerful tool.
You know, I love this quote from Cameron Fry. It's just perfect for what we're talking about. Investing isn't a passive sport. It's not just about picking winners and hoping for the best. It's about having a plan to actively defend what you've built. It's about deciding to take a stand before the storm even rolls in.
So here's our game plan. First, we'll talk about a common headache for investors. Then, we'll introduce a much simpler solution. After that, we'll dive into a real-world example with actual numbers, lay out a clear 7-step playbook you can follow, and then wrap it all up with the biggest lessons you need to remember.
Okay, let's jump right into the problem. You know, for a lot of us, when we think about protecting our stocks, our first instinct is to do it one by one, right? You've got 15 stocks, so you set up 15 separate hedges. It makes sense on the surface, but believe me, in practice, this creates a whole new world of problems. And man, the downsides pile up fast. First off, trying to manage a dozen different hedges it's a huge pain. It's tedious, it's time-consuming. Every single one of those trades also costs you money in commissions, which slowly eats away at your profits. And here's a big one. What about your mutual funds? You can't just go out and buy a put option on a mutual fund, so a big chunk of your portfolio is left completely exposed. It just really handcuffs you.
So if going one by one is such a nightmare, what's the smarter way to do it? Well, instead of running around trying to cover every single plant in your garden when it starts to rain, what if you could just use one big, giant umbrella that covers the whole thing?
And that umbrella, it's called a portfolio put. So what is this thing really? A put option is basically a contract that goes up in value when the thing it's tied to goes down. So with a portfolio put, you buy a single put option on a broad market index like the S&P 500. So if the entire market starts to fall, your stocks might be losing value, but your put option is gaining value, which helps cancel out those losses. It's just one hedge for the whole shebang.
This is truly the best way to visualize it. I mean, think about it. You don't buy a separate insurance policy for your TV, another one for your sofa, and another one for your computer. No way. You buy one renter's or homeowner's policy that covers everything inside. A portfolio put works on the exact same principle. It's one broad policy that protects all your assets from a market-wide storm.
All right, theory's great, but let's make this real. Let's get our hands dirty and walk through a practical example. We'll use a $250,000 portfolio to see exactly how this umbrella concept plays out in the real world.
So picture this. You've worked hard, you've saved, and you've built up a portfolio worth $250,000. It's mostly in solid, large-cap stocks, and you decide, you know what, my personal line in the sand is a 10% loss. I am not willing to lose more than 25 grand. The tool we're going to use to enforce that rule is options on the S&P 500 index, which has the ticker SPX.
Okay, so this is where the rubber meets the road. We have to answer two absolutely crucial questions to get this right. We know what we want to protect, and we know our tool, but how exactly do we set it up? It all boils down to figuring out the perfect strike price for our puts and the right number of contracts to buy.
Now, don't let the table scare you. Let's just walk through it step by step. So, the SPX index is at 1,300. Our 10% line in the sand means we set our strike price 10% lower, which lands us at 1175. That's our trigger. Simple enough. Now, how much does each contract protect? Well, SPX options have a 100 multiplier, so you just multiply the strike by 100. That gives us about $117,000 of protection per contract. Now, here comes the most important part. We are not hedging the full $250,000. Why? Because we already decided we're okay with losing that first $25,000. So we only need to insure the remaining $225,000. We just divide that by the value per contract, and voila, we need about 2 put contracts. See? The key is to think in portfolio dollars, not in individual shares.
Now, of course, this kind of insurance isn't free, so what's the price tag? Let's say a put with that strike price and 6 months until it expires costs about $25. With the 100 multiplier and the 2 contracts we need, the total bill comes out to $5,000. That's the cost for a half year of serious peace of mind. So let's put that $5,000 cost in perspective. When you actually do the math, that protection is only costing you about 2.2% of the capital it's actually hedging. Think about that for a second. For just over 2% every 6 months, you're putting a hard floor under your portfolio. And, there's a huge psychological win here. Knowing you can only lose a certain amount can be the one thing that stops you from panic selling at the absolute bottom of the market. That's powerful stuff.
But of course, the real world is messy, right? It's never that clean. What happens when the numbers don't line up perfectly? Let's say you need a hedge, I don't know, $173,000. One of those big SPX contracts isn't enough coverage, but 2 is way overkill. You can't just go buy 1.5 contracts. This is the classic Goldilocks dilemma. It's a really common problem.
And the beauty is, there's an elegant solution. If the SPX contract is just too big of a tool for the job, you simply pick a smaller tool. For instance, you could use options on the SPY, which is the big S&P 500 ETF. It tracks the same index, but it trades at a fraction of the price. Or you could use the OEX, which tracks the S&P 100. As you can see here, by switching to a different vehicle, we can get much more precise. Instead of that impossible 1.5 contracts, we could use maybe 15 SPY contracts or about 3 OEX contracts, and really fine-tune the hedge so it's just right for our needs. Okay, so we've looked at the problem, we've seen the solution, we've walked through an example. Now let's boil this all down into a simple 7-step playbook you can use to put this strategy to work for yourself.
And here it is, the whole process. Step 1, you have to know the exact dollar amount you've got at risk. Step 2, you've got to define your maximum pain point. Is it 8%, 10%? This is personal.
Step 3, pick the right tool for the job. SPX for a big portfolio, maybe SPY for a smaller one. 4, use that risk number from step 2 to set your strike price. 5, give yourself time. Pick an expiration date at least 6 months into the future. 6, run the numbers to figure out how many contracts you need. And finally, step 7, take a look at the total cost and ask yourself, am I willing to pay this price for this level of protection?
All right, let's pull back from the nitty-gritty for a minute and focus on the big picture. These are the key lessons, the most important ideas you should take away from this whole strategy.
Here's what you really need to drill down on. First, one simple portfolio hedge is way more efficient than managing dozens of little ones. It saves time, it saves money. Second, remember, it's an umbrella. It's for broad, market-wide storms. Third, you're hedging dollars, not specific shares. Fourth, the process isn't random. It's a repeatable system. But, and listen, this is absolutely critical, this strategy will not save you if one of your specific companies reports terrible earnings and its stock tanks while the rest of the market is doing just fine. That's single stock risk, and that's a whole different ballgame.
And that brings us full circle, right back to where we started, back to taking a stand. This strategy is one of the most effective ways you can do that. It's about shifting your mindset from passively hoping things turn out okay to actively, intentionally defending what you spent so much time and effort to build. So, I'll leave you with this final thought. You've built it. Are you prepared to defend it?
All right, let's talk about one of the most powerful and maybe one of the most misunderstood tools in options trading, the vertical spread. You know, if you've ever thought, I want to bet on this stock going up, but then you get scared off by the crazy high cost of buying options or the absolutely terrifying unlimited risk of selling them, well, this is for you. We are going to break down exactly how spreads solve that big problem, step by step. So, why are we starting with a quote from One Harry Met Sally? Because honestly, it perfectly nails a huge trap in options trading. It is so easy to think you're making a simple, low-maintenance bet. You know, I think the stock's going to go up, when in reality, the strategy you picked is actually super high maintenance, loaded with huge costs or scary, unlimited risk. Vertical spreads, they're the antidote to that. They force you to be precise, to define your risk and your reward right from the start. This is all about giving you that control and clarity. Okay, so to really get why spreads are so great, we first have to understand the core problem they're built to solve. And for pretty much any options trader, that problem really just boils down to a fundamental trade-off between cost, risk, and reward. And yeah, this slide lays out that dilemma perfectly. On one side, you can just buy an option, and you get that exciting lottery ticket potential of unlimited gains. But it comes with a pretty steep price tag, a premium that can and often does just go straight to zero if you're wrong. On the other side, you could sell an option, collect that premium up front, which feels great, kind of like getting paid to wait. But now you are on the hook for potentially unlimited losses if the stock makes a huge move against you. So you're stuck, right? Choosing between a high cost or a terrifyingly high risk. There's got to be a better way. And that, my friends, is exactly where vertical spreads come into the picture. They're not some wishy-washy compromise. They're a really clever synthesis. By combining two options, one that you buy and one that you sell, you create this single, defined position that tackles both of those problems at the very same time. Let's see how it works. So first things first, don't let the jargon intimidate you. A vertical spread sounds complicated, but it's really just buying one option and selling another at the exact same time. That's it. They're the same type, so you're working with two calls or two puts, and they both expire on the exact same day. The only thing that's different is the strike price. And that little difference is what creates the spread and gives it all its power. And this basic structure gives us four main flavors. You get two for when you're bullish and two for when you're bearish. Now, you see the words debit and credit here. It's simple. A debit spread is one where you pay a net amount to put on the trade, kind of like buying a stock. A credit spread is one where you actually receive a net payment. Money goes into your account, just like when you sell an option. We're about to see exactly how this plays out. Okay, theory is one thing, but the absolute best way to understand this stuff is to just build one from the ground up. So let's walk through a real-world example using a super common bullish strategy, the bull call spry. All right, here's our setup. Let's imagine Goldman Sachs, stock ticker GS, is trading at $150 a share. You've done your homework, you've looked at the charts, and you're thinking, this stock is going up. You want to put on a bullish trade. So you've got a couple of choices. Strategy A is the classic move. Just buy a call option. Let's say we buy the $135 strike call. It'll cost us $21 or $2,100 for the contract.
Now, check out strategy B, our spread. We do the exact same first step. We buy that 135 call, but at the same time, we sell a higher strike call, the 160, and we collect $7 or $700 for it. Now look at the immediate difference. Our net cost for the spread is only $1,400. Right off the bat, we've saved $700. Now let's look closer at strategy A, the single call. Your max loss is simple. It's the $2,100 you paid. Your max gain, well, it's theoretically unlimited, which sounds amazing. But here's the kicker. Your break-even price is $156. Now, with the stock currently at $150, Goldman Sachs has to rally more than 4% just for you to get your money back. That is a pretty high bar to clear. Okay, so how did we build that spread again? It's just two simple parts. Step 1, we buy the lower strike call, the 135. Think of this as the engine of our trade. It's what gives us that bullish power to capture the upside if the stock moves. Then, step 2, we sell the higher strike call, the 160. Think of this part as a subsidy. That $700 in premium we collect helps pay for the engine, and that's what dramatically reduces our total cost to get into the trade. And just look at what this does to our risk profile. It's a total transformation. Our max loss gets slashed down to just $1,400. And our break-even price, it drops all the way from $156 down to $149. Now, just think about that for a second. The stock is at $150 right now. That means our spread is already in a profitable position. If the stock just stays flat or even wiggles up a tiny bit. Of course, there's always a trade-off. We've capped our maximum gain. If Goldman Sachs skyrockets to 300, our profit is exactly the same as if it just goes to 160. So that's the big trade-off right there, laid out plain and simple. That's the heart and soul of the vertical spread. You are consciously, deliberately trading away that lottery ticket of unlimited gains, and what do you get in return? You get a significantly lower cost, a much, much easier break-even point to hit, and a risk profile that is completely defined before you ever click buy. For a lot of traders, that is a trade they are more than happy to make every single time. All right, let's put some really precise numbers on this risk and reward profile. And while we do that, I'm going to highlight a critical warning that every, and I mean every, spread trader absolutely needs to understand. Here it is, all laid out. Our maximum possible gain is $1,100. And you can see the calculation below. You just take the width of the spread, which is $25, and subtract what we paid for it. Our max loss is simply the net cost we paid, that $1,400. And our break even, like we said, is the lower strike plus our cost, which gets us to $149. The huge takeaway here is that none of this is a guess. None of it is a mystery. These are all hard numbers you can calculate before you ever risk a single dollar of your capital. Okay, now for that warning. Please listen to this. Because spreads are so much cheaper, they introduce something called implied leverage. In our example, we are controlling 100 shares of a $150 stock for only $1,400. The temptation here is to think, wow, this is so cheap. I could buy 10 contracts instead of one. Do not do it. This is how people blow up their accounts. It is absolutely critical to keep your entire portfolio's implied leverage below 1.0x. In other words, don't use options to control more stock than you could afford to just buy outright with the cash in your account. Now, the really beautiful thing about this structure is that it's not just for when you're feeling bullish. The same exact logic of buying one option and selling another can be flipped and twisted and adapted for almost any market view you could possibly have. It really expands your toolkit. So we just walked through the bull call spread. That's a debit trade, you pay for it, and it profits when the stock moves up. But you can also be bullish with a bull put spread. This is a credit trade. You get paid up front to put it on. With this one, you win if the stock goes up, if it stays flat, or even if it drops a little bit, as long as it stays above your short strike price when it expires. It's a strategy that can profit from the stock moving the right way, but also just from time passing by. And the exact same logic works on the bearish side. If you are really confident a stock is going down, a bear put spread, which is a debit trade, is a fantastic choice. But what if you're just not that bullish? Maybe think the stock is going to go sideways or drift down a bit. Well, you can use a bear call spread. That's a credit trade, or time is your friend, and you win as long as the stock stays below your short strike price. So you see, you have a really precise tool for almost any opinion you have on a stock. So the big question is, how do you put all this together into a process you can actually use? Let's wrap this up with a simple, actionable framework you can use to think about bringing spreads into your own investing strategy. Okay, here it is, a simple 5-step framework. First, and I mean this is the most important, start with your allocation plan. How much of your portfolio are you willing to risk on this one idea? Decide that first.
Then move to step 2. What is your actual projection for the stock? Are you super bullish, mildly bullish, neutral? Get specific. Step 3 flows right from that. Select the right spread and the right strike prices that match your outlook. Step 4, now you calculate your position size, and you base that on your allocation from step 1, not on how cheap the spread seems. And finally, step 5, and I'm going to say it one more time, you have to continuously track your portfolio's leverage. Make sure it always stays in a safe zone you are comfortable with.
And that really brings us to the final and most important question, and it's one that only you can answer. Vertical spreads represent a very clear trade-off. You are swapping that dream of unlimited lottery ticket gains for a much lower cost, a higher probability of success, and strictly defined risk. So for your own investment goals, for your personal risk tolerance, is that a worthwhile trade? Answering that question for yourself is really the key to using these powerful tools effectively. Thanks for tuning in.
You've heard that old saying a million times, right? Time is money? Well, in the world of options trading, it's not just a saying, it's literally how the game is played. And today, we're going to break down a really slick strategy, an advanced one, called the diagonal spread. It's built from the ground up on that very principle.
I love this quote because it gets right to the heart of it. For us options traders, time is the currency. Every single option has a built-in clock ticking down to expiration. And as that clock ticks, value just evaporates. That's called time decay. Now, the diagonal spread, it's a really clever way to rig this game in your favor, to take advantage of the fact that some clocks tick a whole lot faster than others.
All right, here's what we've got on tap. First, we'll define what a diagonal spread actually is. Then, we'll dig into that time is money tactic. We'll look at a killer winning trade on Apple, then flip the coin and see a cautionary tale with General Dynamics. And finally, we'll pull it all together with the big takeaways.
Okay, let's dive right in. What is a diagonal spread? To really get it, we need to move beyond a strategy you probably already know, verticals. So, at its core, a diagonal spread is where you're trading the same kind of option. So you're using 2 calls or you're using 2 puts. But here's the twist, and this is everything. You're using different strike prices and different expiration months. It's those 2 differences, moving across both price and time, that give it the name diagonal. And that's where all the magic happens.
And this right here, this lays it out perfectly. Look, with a vertical spread, you've got different strikes, sure, but the expiration month is the same. That means both of your options are on the same clock. Time decay is affecting them in a pretty predictable, balanced way. But with a diagonal, you intentionally break that balance. You pick different expiration months. You are literally pitting one option's clock against the other. It's like setting up a race, and your goal is to profit from the winner.
All right, so we've set up this race. Now let's talk about the tactic itself. How do we actually make that ticking clock, that time decay, work for us for a change, instead of always being the enemy?
The best way to think about this is like real estate. Seriously, step 1, you buy the property. That's your far month option, maybe 6, 8, even 12 months out. It's a long-term asset. Now, step 2, you become a landlord. You immediately sell a near month option, say 30 days out. This is you renting out your property for the month and collecting that rent check, that premium. Then, step 3, you just do it again. Next month, you sell another short-term option, and again the month after that. You're essentially renting out your long option over and over, using that monthly income to chip away at what you paid for the property in the first place. And this chart shows you exactly why that landlord strategy is so powerful. That big bar on the left? That's your house, your long-term option. See how slowly its value decays over time? It's a solid asset. Now look at those other bars. Those are your rent checks, the short-term options you're selling. Their time value is an ice cube on a hot sidewalk. It just melts away, especially in those last 30 days. So you're collecting income from these fast-melting assets, while your main asset, your house, is holding its value. You're essentially arbitraging time itself. It's beautiful.
Okay, enough theory. Let's put this into practice with a real-world example. We're going to look at a fantastic trade on Apple, all the way back in 2010.
All right, so here's the setup. On May 24th, the trader is bullish on Apple. First, they buy their house. That's 1 January 2011, 230 call. It's got plenty of time on it, about 8 months. That costs $44. Then, right away, they sell their rent check, a June 270 call that expires in about a month, and they collect $3.55 for it. So, you do the math. Their net cost to get into this trade, their total risk, is $40.45. That's the absolute max they can lose, period. So 1 month goes by, and what happens? Apple just explodes, shooting up to 274. Now this is a good problem to have. The short call we sold at 270 is now in the money, which isn't ideal on its own. But our long call, the one we bought at 230, has gained a ton of value. When you put the two pieces together, the whole spread is now sitting on a profit of $14.30. Think about that. That's a 35% gain on our risk in just 1 month.
And this right here is where this strategy really earns its advanced label. This isn't passive investing. A huge fast move like this forces your hand. The game plan just changed completely. Now you have a big decision to make. So, what do? You've got a 35% gain staring you in the face way sooner than you ever expected. Do you just take the win, or do you try to stick to the landlord plan? You've got options, literally. 3 of them, in fact.
Okay, choice number 1 is the easy one. You close the whole thing out, bank that $14.30 profit, and go have a nice dinner. A 35% return in a month? Nobody's going to argue with that. Choice 2 is the landlord plan. You buy back that short June call and sell a new one for July, collecting another rent payment. But then there's choice 3, and this is where it gets really interesting. You could just do nothing. Let that short call expire in the money, get assigned, and find yourself short 100 shares of Apple stock.
I know what you're thinking. Wait, why would I want to be short Apple? I was bullish. And that's a fair question. But look at what's really happened here. Yes, you're short 100 shares of the stock, but you still own that long-dated 230 call. That call acts like an insurance policy against your short stock position. You've essentially morphed your trade. It's now a hedge position that could actually make more money if Apple pulls back a bit. You've locked in a lot of your profit and created a new way to win. It's a very slick, next-level adjustment.
Okay, the Apple trade was a thing of beauty. But, and this is a big but, this strategy is not a silver bullet. It doesn't print money automatically. So to give you the full, honest picture, we need to look at a time when it didn't really work. Let's check out a trade on General Dynamics.
So this was the same landlord strategy, set up on General Dynamics and managed over 8 months. The idea was identical. But just look at those monthly premium numbers. After the first month, the rent checks are pathetic. We're talking 35 cents. At one point, just 5 cents? What's going on here? Well, the stock just sat there. It didn't move. There was no volatility. And without movement or volatility, the short-term options just aren't worth very much. You can't collect enough rent to make a difference.
And this is the final result. After 8 months of managing this thing, placing 9 separate trades, tracking it constantly, the total profit was 55 cents. I mean, that's just brutal. All that work, all that time for pocket change that probably didn't even cover the trading fees.
But wait, it gets worse. Here's the real gut punch. If the trader had just used a simple vertical spread instead, a basic, easy-to-manage trade, they could have made $2.45, almost 5 times more money, for about 1/10 of the effort. This is such a critical lesson. Sometimes the more complex, sophisticated tool is not the right one for the job. Sometimes you just need a hammer.
So we've seen both sides now. We saw the home run with Apple, and we saw the frustrating grind with General Dynamics. So what are the big lessons here? What do you really need to remember?
Okay, let's nail this down. First, the definition. Diagonals are all about using different strikes and different expiration months. That's what makes them tick. Second, remember the landlord analogy. The whole point is to pay for your long-term asset by repeatedly selling short-term ones. Third, and I can't stress this enough, this is an active strategy. You have to manage it. It's not set and forget. And finally, always remember the General Dynamics trade. Before you put on a complex diagonal, ask yourself, could a simple vertical do the job better? Sometimes simpler really is smarter.
Look, there's no doubt the diagonal spread is a powerful, elegant strategy. It's a fantastic tool to have in your toolbox, but it's not for beginners, and it's definitely not passive. It demands your attention. It demands that you're ready to make decisions on the fly. So the final question isn't just about understanding the strategy, it's about understanding yourself as a trader. Is your analysis, and are you ready for it? Thanks for watching.
You know, we spend so much time focused on the stocks, the bonds, the sexy parts of our portfolio, but what about the cash? It's usually just an afterthought, but for savvy investors, especially those using sophisticated hedging strategies, a big pile of cash isn't just a possibility, it's pretty much a guarantee. So the real question becomes, is that cash working for you, or is it just dead weight dragging down your returns? Today, we're going to figure that out.
Right. You might not literally be able to smell the money in your brokerage account, But when you've got a huge chunk of it just sitting there as cash, oh, you can feel it. It's just there. A constant reminder of capital that isn't really doing anything. So today, we're going to dive into how to put that money to work, but to do it intelligently.
Okay, here's our game plan. First, we're going to unpack why this excess cash problem even exists. Then we'll cover the standard, safe stuff people usually do with their cash and why that might not be cutting it. After that, we get to the really interesting part, a more advanced strategy for juicing your yield. We'll break it down step by step with a real-world trade and then wrap it all up by talking about how you can figure out if the risk is worth the reward.
So, first things first, where's all this cash coming from? I mean, it sounds like a pretty good problem to have, and it is. But it's actually a direct side effect of using some really powerful and, frankly, very efficient hedging strategies.
The whole thing boils down to one word: leverage. And it's just baked right into how options work. Think about it. Options give you control over a huge number of shares, getting you that big market exposure. But you don't have to put up all the cash to buy the shares outright.
And this slide right here just lays it out perfectly. Look at the left. To get 100 grand of market exposure by buying stock, well, you need 100 grand. Simple enough. But now look at the right. By using an in-the-money option strategy, you might only need, say, $20,000 of your capital to get the exact same $100,000 of exposure. So what happens to the other 80 grand? It just sits in your account as cash. And boom, there's the result. In that example, a whopping 80% of your capital is freed up. For a portfolio that wants $100,000 of exposure, you could have $80,000 just sitting on the sidelines. That is a huge amount of idle capital.
Okay, so you've got all this cash. What do most folks do with it? Well, they turn to the usual suspects: the safe, the conventional, the totally boring options for parking money. Let's take a look at that standard playbook. Yep, you've got your broker's sweep accounts, money market funds, and good old CDs. Now look, if you have a portfolio with maybe 10% in cash, these are perfectly fine, no problem at all. They keep your cash safe, they keep it liquid. But when 80% of your portfolio is cash that's earning next to nothing, well, that's not just a missed opportunity, it's a massive drag on your performance.
But let's even question that word safe for a minute. Anybody remember 2008? That was a brutal reminder that nothing is 100% guaranteed. We saw banks failing, and for the first time ever, some money market funds actually broke the buck. That means they couldn't even return a full dollar for every dollar invested. All of a sudden, who was holding your cash mattered. A lot.
And that brings us to insurance limits. Right now, FDIC insurance covers you up to $250,000 per depositor per bank. You've also got SIPA coverage for brokerages. You have to know these limits. If your cash balance goes over these thresholds at any one place, you are taking on risk that you are not getting paid for. So the takeaway is, even managing safe cash requires some real attention.
All right, we've seen the problem. We've seen why the normal solutions just don't cut it for this scenario. So now, let's get to the good stuff, an advanced strategy. But it's going to require us to, let's say, bend a few of the conventional rules. For all the right reasons, of course. And let's be crystal clear about this right from the get-go. The whole reason those hedging strategies leave you with so much cash is to keep your portfolio's total leverage at or below a nice, safe 1-to-1 ratio. The strategy we're about to talk about means investing that cash, which, by definition, is going to push your total portfolio leverage above 1-to-1. Now, that's a big change to your risk profile, but the key is that we're going to manage that risk very, very carefully. This is it. This is the fundamental, unbreakable law of the market. There's no such thing as a free lunch. Cash equivalents are low risk, and guess what? They give you low yields. If you want to get more yield, you absolutely, positively have to be willing to take on more risk. Our goal is to do that in a really smart, calculated way.
So what is this advanced tactic? It's called the married put strategy. And what it involves is using that excess cash of yours to invest in dividend-paying fixed-income ETFs, while, and this is the critical part, simultaneously using options to put a hard cap on your downside risk.
Don't let the name intimidate you. A married put is a beautiful, simple concept. You buy an asset, in our case, an ETF, and at the exact same time, you buy a put option on that ETF. Just think of that put option as an insurance policy. It gives you the right to sell your ETF at a specific price, no matter how low it goes. It literally puts a floor under your investment.
So here's how it works, in 5 simple steps. Step 1, you invest your cash into an ETF that pays a regular dividend. Step 2, you buy your insurance, that out-of-the-money put option. 3, you sit back and collect the dividends from the ETF.
4, that dividend income you're collecting helps pay for your insurance policy. And 5, your net profit is whatever is left of the dividend after you've paid for that protection. Simple as that.
Now the key is finding the right tools for the job. You need ETFs that not only pay good dividends, but also have a deep, liquid options market so you can buy that protection. And the good news is there are quite a few. This list here shows 7 really liquid ETFs that are perfect candidates for this exact strategy.
Okay, theory is great, but let's make this real. We're going to walk through an actual historical example so you can see exactly how an investor can literally dial in their risk and their potential reward using this strategy.
So we're looking at JNK. It's an ETF that holds high-yield corporate bonds, junk bonds. Back on March 31st, 2011, it was trading for about $40.51. Now, normally, that high-yield name might make you nervous because of credit risk, but remember, we're buying an insurance policy to protect ourselves from the worst-case scenario. Okay, this table right here, this is where the magic happens. Let's really walk through this. Over this 6-month period, the dividend you'd collect from JNK was about $1.56. Now look at that top row. Let's say you want to be super safe. You protect yourself against any drop below $40, so you're only risking about 1%. Well, that insurance is expensive. It costs you almost the entire dividend. Your net yield? Basically zero. The market is telling you if you take no risk, you get no reward. But now check out the second row. What if you say, okay, I'm willing to risk about a 6% drop. You buy the $38 strike put. Suddenly, your insurance cost plummets to just 80 cents. You still collect your full $1.56 dividend, you pay your 80 cents for protection, and you're left with a net profit that works out to a 3.75% annualized yield. Much better. And now look at the third row. What if you're willing to accept an 11% downside? You buy the $36 strike put. Your insurance is now dirt cheap, and your yield jumps to an incredible 7.7%. This is the whole point. You get to choose your risk, and by choosing your risk, you get to choose your potential yield.
So as you can see, this is a seriously powerful tool, but, and this is a big but, it is not a magic bullet. Before you would ever even think about doing something like this, there are a few final, absolutely crucial things you need to understand about managing the risk.
I cannot say this enough. Even with the put protection, this is an investment. It is not the same as a cash equivalent. Yes, you've put a floor on your losses, but you can still lose money down to that floor. You have increased the total capital at risk in your portfolio, and you have to be 100% comfortable with that.
So what's a good way to keep yourself in check? Well, a pretty solid rule of thumb is to make sure your portfolio's total capital at risk doesn't go above 20 to 30% after you've put on a strategy like this. That just helps keep the overall risk profile in a zone that hopefully still lets you sleep well at night.
And really, at the end of the day, that's what this all comes down to. This strategy puts the power in your hands. It lets you, the investor, dial in your own personal risk and reward balance. The market lays out all the options for you, from basically zero risk for zero yield all the way up the ladder. The only question left to answer is what's the right balance for you? Thanks for tuning in.
All right, let's talk about something every investor thinks about, but maybe not in the right way. Taxes. Look, picking winners is the fun part, right? Seeing those gains pile up. But that's only half the battle. The real game is figuring out how to protect those gains from the taxman. Because, let's be honest, it's not what you make, it's what you keep. So today, we're going to dive into the playbook for doing just that.
So to kick things off, I've got a quote from a classic. Caddyshack. Yeah, I know what you're thinking. What in the world does a comedy about gophers and golf have to do with my portfolio? And you know what? You're not wrong. It's tough to find a good movie quote about IRS Form 1099. But trust me, this one from Ty Webb nails a bigger idea perfectly. It's this whole concept that in just about everything, there's the obvious path, and then there's the smart path.
And here's how that connects. Making a profit, well, that's the pool. It's right there, it's flashy, it's what everybody on TV is yelling about, it's the goal everyone's shooting for. But the pond, that's where the real masters play. The pond is knowing how to keep that profit. It's about tax efficiency. It's not as loud, it's not as exciting, but it is the quiet, strategic art of making sure you hand over as little as possible. And believe me, that is the difference between having a good year and building real, long-term wealth.
So, here's our game plan. We're going to treat this like leveling up in a video game. We'll start by defining the mission, tax efficiency. Then we'll hit level 1, the foundational accounts you absolutely have to have. Level 2 gets into the nitty-gritty of taxable account tactics and the huge power of just holding on. And for the grand finale, Level 3, we'll look at a special tool the pros use, By the end, you'll have a complete playbook. All right, first things first. The goal, tax efficiency. What does that even mean? It's a phrase you hear all the time, but let's be real. It's more than just trying to avoid paying taxes. It's a fundamental part of a winning strategy.
So here's the official definition, and there are two parts to this. Both are critical. Part 1 is simple. Create the lowest tax bill you possibly can. No surprise there. But part 2 is where the magic really happens. Delay paying those taxes whenever you can. Think about it. Every dollar you don't send to the government this year is another dollar that stays in your account, working for you, compounding for you. It's like getting an interest-free loan to invest, and that is a powerful, powerful thing.
And this leads to a kind of ironic twist in investing. You know, we're programmed to think of taxes as a punishment. But really, the goal of investing is to have a tax bill. Because what does that mean? It means you made money. The goal isn't zero taxes, that just means you broke even or lost. The goal is to make that tax bill as small and as far off in the future as humanly and legally possible. It's not about avoidance, it's about optimization.
Okay, time for level 1. Look, if you take only one thing away from this whole explainer, this should be it. This is the absolute foundation. This is the non-negotiable first step. If you're not doing this, you're literally just giving away money. Simple as that.
We're talking, of course, about your IRAs and your 401ks. The idea here is beautifully simple, but oh so powerful. Inside these accounts, you can trade your heart out. You can buy, you can sell, you can rack up gains, and you will not see a tax bill on any of that growth. Not this year, not next year. The tax man basically takes a long nap and only wakes up when you start pulling money out in retirement. That delay, that's what lets compounding work its untaxed magic. And think about the freedom this gives you. This is your strategic sandbox. Since you're not worried about getting a tax bill every time you sell something for a profit, you can focus purely on making the best investment moves. Need to rebalance? Go for it. Want to hedge a position? No tax problem. You can make decisions based on what's right for your portfolio, not what's going to complicate your tax return. Okay, so you've done level 1. You're maxing out those foundational accounts. Awesome. Now we're graduating to level 2. We're talking about your regular taxable brokerage account. And this is where things get real. In here, every single move you make can have a tax consequence. This is where true strategy really matters.
And in this arena, it all boils down to two main levers you can pull. Just two. The first is the actual tax rate you pay on your profits. And spoiler alert, not all profits are created equal in the eyes of the IRS. The second lever is the timing of when you pay. That's it. You learn how to control those two things, you win the game.
So let's tackle that first lever, the rate you pay. This is probably the biggest and most powerful one for most people. And it all hinges on one simple but crucial factor: how long you held on to your investment.
And the difference here is it's huge. It's night and day. If you hold something for less than a year and sell it for a profit, that's a short-term gain. Boom. You're taxed at the same high rate as your regular paycheck. We're talking 28, 30, almost 40% for some people. But if you can just hold on for 1 year, just 1 year and a day, that same profit magically transforms into a long-term gain. And the tax rate, it drops way down to 20% or even less. Think about that. We're talking about potentially cutting your tax bill in half just by being patient.
So the big question is, how do you manage risk while you're waiting for that 1-year clock to tick? Well, that's where some clever hedging tactics come in. Things like married options or collars. Don't worry too much about the names. The point is, these strategies let you hold on to your main investment, your stock or your ETF, for the long haul to get that sweet, sweet long-term gains rate, while you use shorter-term options as a kind of insurance policy to protect your downside. It's the best of both worlds. So this lays it out pretty clearly, right? On one side, you've got your less tax-efficient tactics, stuff like option spreads. These are made up entirely of short-term instruments. So guess what? Any profit is a short-term gain, period. High tax rate. On the other side, you have the more tax-efficient plays, the collars, the hedges we just talked about. They are built on a foundation of owning a stock for the long term. That's where you get your long-term gains. The takeaway here couldn't be clearer. In a taxable account, you want to live on the right side of this chart. But what if your strategy is short-term? What if you want to use spreads? Are you just stuck paying those high rates? Well, now we get to level 3. This is the pro's move. It's a special vehicle, a kind of tax loophole that can make even short-term trading way more efficient. And that tool is something called equity index options. Now, these aren't your typical options on a single stock like, say, Microsoft. These are options on the big, broad market indexes themselves. Think the S&P 500. And for whatever reason, the tax code has carved out a special little section just for them. They're called Section 1256 contracts, and they get a tax treatment that is frankly amazing.
Here's the deal. Any profit you make on one of these contracts gets chopped in two for tax purposes. 60%, the big chunk, is automatically treated as a long-term gain, getting that nice low tax rate. The other 40% is short-term. What you end up with is this blended rate that's way better than the normal painful short-term rate. It's a huge built-in advantage.
But wait, it gets even better. This is the absolute killer feature. That 60-40 split applies, wait for it, regardless of how long you held it. You could be in and out in a day, an hour, it doesn't matter. You still get that 60% taxed at the lower long-term rate. For anyone doing short-term trading in a taxable account, this isn't just a nice little trick. It's an absolute game changer.
And just so you know what we're talking about, here are the big ones. You've got SPX, which tracks the S&P 500, RUT for the small caps, NDX for the NASDAQ. These are the tickers to look for. If you're planning on trading the indexes short-term, using these is just a no-brainer from a tax perspective. Whew, okay. We have covered a ton of ground, right? From the absolute basics to some pretty advanced pro-level stuff. So let's put it all together. Let's build your tax-efficient playbook, a simple checklist you can use to make sure you're keeping more of what you earn.
It really comes down to 3 simple rules. Rule number 1, maximize your foundations. Before you do anything else, you fill up those tax-advantaged accounts like your 401k and IRA. That's your first and best line of defense. Rule number 2, in your taxable account, play the long game. Always be aiming for that 1-year mark. Prioritize strategies that get you those lower long-term capital gains rates. And finally, rule number 3, if you have to go short-term, use the pros tool. For things like spreads, use those equity index options to get the incredible 60-40 tax advantage. That's it. That's the playbook.
See, when you start following these rules, you're not just investing anymore. You're thinking like a professional. You're consciously deciding to step away from the splashy public pool and start cultivating wealth in the quiet, strategic pond. So I'll leave you with this thought. You've just learned how to master one of the biggest hidden rules of the game. What other ones are you ready to tackle next?
All right, welcome. Today, we're diving into a concept that can seriously transform your investing, moving it from something that feels, a little chaotic and stressful into a disciplined, successful routine. We're going to talk about finding your rhythm, your own unique tempo in the market.
You know the line. It's what it's all about, right? It's the ultimate goal for any of us who invest for ourselves. That amazing feeling of seeing your portfolio grow because of the work and the discipline you put in. It's just so satisfying.
And that is the million-dollar question, isn't it? It doesn't just happen. It's not luck. It takes real effort, a solid commitment, and maybe, most importantly, a consistent, repeatable routine. And that's exactly what we're going to break down right now. So here's our game plan. We're going to start by understanding what this rhythm of success even is. Then we'll define investor tempo. After that, we'll look at the fundamental laws of investing, the ones you just can't ignore. And then we get to the good stuff, the 5 powerful rules to master them. And finally, we'll pull it all together for you.
Okay, let's kick things off with this idea of rhythm. In pretty much any field where people perform at a high level, the absolute best of the best have a certain cadence, a tempo that guides everything they do. It's not just about what they do, but the rhythm in which they do it. Just think about a great golfer for a second. When they're on their game, people will literally say their tempo looks great. It's this perfectly coordinated, repeatable motion from the backswing all the way to the follow-through. That smooth rhythm is what leads to consistently great shots. Or how about a dominant baseball pitcher? You'll hear the announcers point it out, how they take the exact same amount of time between every single pitch, how their windup is the same speed every time. That consistent tempo is a dead giveaway that they are in the zone and in complete control. And this one really nails the point. Think about quarterbacks. They build a specific rhythm with their receivers, running those timing patterns again and again and again until they are perfectly in sync. That coordinated tempo is what wins games, and it comes from practice and discipline. So what's all this got to do with us? Well, this is what we're calling your investor tempo. It's your personal, disciplined routine for managing your portfolio. It's all about building that same repeatable pattern of analysis and action that, just like in sports, requires practice and discipline. Okay, let's get a little more specific here. Because finding your tempo isn't just about logging hours staring at stock charts. Not at all. It's about being efficient and being effective. Now, this right here is a really interesting contrast. See, poor tempo can come from two opposite problems. You either spend so little time that you start to neglect your own rules, or, and this is just as bad, you spend so much time that you get jumpy and overreact, breaking your rules anyway. The perfect tempo is that sweet spot. Just enough time to get the job done right, and not a minute more. So how do you actually find that sweet spot? Well, the source material suggests aiming for 1 or 2 dedicated sessions a week. That seems to be the ideal cadence. Trying to manage everything just once a month, well, that puts you at a real disadvantage. And on the flip side, checking in every single day can lead you down a rabbit hole of emotional, knee-jerk mistakes. The key takeaway is this: let your ability to follow the rules be your compass. If you're consistently executing them, your tempo is probably just right. Now, to really get why this tempo and these rules are so critical, we have to first wrap our heads around the fundamental challenges that every single one of us faces as an investor. These are the immutable laws of the game. The source material uses such a great analogy here. These laws, they're like gravity. You can't argue with gravity. You can't wish it away. It affects everyone, from the brand new investor to the hedge fund billionaire. Doesn't matter if you jump off a diving board or a skyscraper, gravity's going to do its thing. The trick is to understand it and work with it. And here they are, the 5 core challenges. First, capital you lose is gone for good. It can't grow. Second, risk is what you have to put in to get a return out. Third, your own emotions can absolutely be your worst enemy. Fourth, volatility can just wreck your best laid plans. And finally, remember this: it's not what you make, it's what you keep after taxes that really matters. So, if those are the laws we can't avoid, what on earth do we do? Well, we can't change them, but we can equip ourselves with a powerful set of tools designed specifically to navigate them. And this is where we introduce the 5 iron rules. This is a massive shift in mindset. These rules aren't about holding you back, they're about empowerment. They're the techniques you use to work with those laws of gravity, so you can dive into the water perfectly instead of, belly flopping. They give you control. And here is that toolkit: hedging your investments, truly deeply understanding your risk, building a smart portfolio for the long term, developing the discipline to keep emotion out of it, and actively managing your gains and losses. These are the core tenets of the buy and hedge strategy. But here's where the magic really happens. The source is crystal clear on this. While each rule is great on its own, their combined power is way bigger than the sum of their parts. So 1 + 1 + 1 + 1 + 1, it equals more than 5. They work together, they reinforce each other, and they can totally transform your potential for success. And this just illustrates that connection perfectly. I mean, look at this. Each rule is a direct response to one of those immutable laws. Is emotion your enemy? You unleash your inner guru to build discipline. Is volatility kryptonite? You hedge every single investment. Worried about losing capital for good? You harvest your gains and losses. For every single one of those fundamental challenges, there is a specific, actionable tool. Okay, so we've covered the tempo, we've covered the laws, and we've covered the rules. Now let's tie it all together into a clear path that you can actually start walking down today. This right here, this is the core idea of this whole explainer. This is the big takeaway. Your main goal is to find and maintain that perfect tempo. And the way you do that is by consistently applying the 5 iron rules. The rules guide the tempo, and the tempo makes it possible to follow the rules. They're 2 sides of the very same coin. And here it is, laid out in 3 simple steps. First, you have to truly understand and respect the fundamental laws of investing. Second, you commit to actually executing the 5 iron rules. That's your toolkit. And third, you use that whole framework to find and maintain the routine, the tempo that works for you and keeps you on track. And let's end on this really powerful quote from the source. This is not just a bunch of random tips you can pick and choose from. It is a holistic, complete system for building and managing your money. When you use all 5 rules together, you're not just investing, you're building a comprehensive strategy for success over the long haul. So now it's your turn to put this into action. I want you to really think about your own routine. Are you spending too much time stressing? Or maybe not enough? Are you letting emotions get the best of you? This whole journey begins with one single step. So what's yours going to be?